Good morning, everyone. It is Tuesday, May 16th here in New York City. I'm Brad Smith alongside Julie Hyman. This is Yahoo Finance Live, and here are the three things that you need to know to start your morning. A brutal earnings report from one of the nation's biggest retailers, Home Depot, warning on sales after its biggest revenue miss in over 20 years. The home improvement retailer's fiscal first quarter net income came in at $3.87 billion. That's down from $4.23 billion last year. The report spells bad news for the economy, with consumers backing off from big projects and spending less on things like patios and grills. Shareholders, they don't like it one bit. The last time Home Depot missed this badly, Justin Timberlake was still in NSYNC. April's retail sales coming in at 0.4% on the month. That's below estimates for growth of 0.8%. Now, it's still a notable improvement from the drop that we saw in March. The number underscores a still resilient labor market and adds to the debate over Fed policy. A key meeting looms in June, with investors largely expecting the central bank to hold steady on rates, though expectations for a hike haven't been completely discounted. And Berkshire switches up its bank holdings. Fresh regulatory filings from the SEC, more commonly known as 13Fs, coincidentally also the title of my golf game, show that the Oracle of Omaha's investment house exiting U.S. Bank and Bank of New York Mellon. Now, on the flip side here, it has begun investing in Capital One. This is a lender known for having a large share of the U.S. auto finance market, and the moves come amid turmoil for regional banks. We'll keep an eye on that with the SVB and Signature Bank hearings on the Hill this morning.
Yeah, you know, Justin Timberlake, big DIY guy, but I guess he wasn't doing any projects this quarter. Shares of Home Depot falling in pre-market trade, down about 2.5%. The home improvement retailer hit hard by softening sales growth. Guidance for the year was bleak as well, to say the least. Yahoo Finance's Brooke DePalma is joining us now with more of a look at those earnings. So really, the company, it's unusual for it to make commentary like this.
Right. Well, I think that the home improvement sector just has such a stark difference than what we saw during the pandemic. And now we're really seeing that come to fruition in this latest earnings results. Taking a closer look at the numbers, they mostly miss estimates here. Revenue coming in lower than expected at $37.26 billion. Adjusted, slightly beating their adjusted earnings per share, slightly beating at $3.82. But here are my top three takeaways from the quarter. We saw consumers spending less. CEO and President Ted Decker saying in the earnings release that after a 3-year period of what he said was unprecedented growth, the company expected that fiscal 2023 would be a year of moderation for the home improvement market. And customers seem to be going to the store less. We saw transactions decline here 4.8% year over year. And they're also buying less big ticket items. Think less appliances that maybe we saw people bulk up on during the pandemic, less flooring, kitchen and bath items. Ticket sizes only increased about 0.2%. Also keeping in mind that we saw higher inflation year over year. But as you can see here, overall sales down 4.5%. Here in the U.S. specifically, down 4.6%. Those were far lower than what Wall Street analysts anticipated here. What's driving those sales lower? Here's my second takeaway. Lumber deflation, extreme weather also impacted the quarter. We saw unfavorable weather, particularly out west, and extreme weather in California. The CEO said that disproportionately impacted our results. So think less grills being bought and perhaps less money spent on patio furniture as consumers didn't make their way outside, perhaps put off those home improvement projects because of this weather. And ultimately, that led to this, the company updating its fiscal 2023 guidance. We haven't heard too many companies update their fiscal 2023 guidance, given that it only is the first quarter, but Home Depot certainly did here. Based upon the results, the CFO said that they expect continued uncertainty regarding consumer demand, and they now expect comparable sales to decline between 2 and 5% compared to fiscal 2023. Now, previously in Q4, the company expects sales growth to be flat year over year. And in addition to that, they also noted that they expect operating margin rate to be between 14.3% and 14% in fiscal year 2023. That's slightly lower than what they anticipated previously of 14.5%. But you have to keep in mind that earlier this year, the company did announce a $1 billion in wage investment. So that also weighing on this guidance as well. But as you noted earlier, Home Depot shares dropping in pre-market here. They dropped as much as 5.5% earlier today.
Yeah, and the call is starting right now, so we should get some more color from that. Thank you so much, Brooke. Appreciate it. We're also going to get some more color and more perspective from Michael Lasser, UBS hardline and broadline food retail analyst. He's coming up in the next hour to react to those numbers. Let's also talk about retail sales more broadly. They came in lower than analyst estimates, but still a rebound. It rose 0.4% for the month of April, snapping a streak of monthly declines. When excluding autos and gas, spending picked up more than Wall Street's expectations, up 0.6%. And economists had been looking for a gain of 0.2%. So basically what that tells us is that, Brad, a big weight in the month was coming indeed from autos, from gasoline. Gas station sales down 14.6%. So that was an area of weakness. Electronics and appliances down 7.3%. Furniture and home furnishings down 6.4%. So a lot of areas of weakness. But what stuck out to me as well were some of the interesting area. Oh, excuse me. I'm quoting numbers year over year by mistake. That's what I get for looking at the wrong column on the chart.
We've got some of the month over month.
Those are the right numbers. Wow.
Viewers, yeah. And looking at some of those key segments, it's really interesting considering the earnings reports that have already come out and those that are still coming over the course of this retail portion of the earnings season. And I think back to the electronics category and really what had been mentioned already over the course of Apple, Amazon, all of these different companies that are waiting for the consumer to get back into a purchasing, a cyclical purchasing kind of tenor. And as of right now, that's continuing to hit those electronics and appliance stores. We're seeing that year over year and in the month over month here still. But then additionally, some of the other characteristics on the other side where consumers are perhaps leaning into the little luxuries, whether it's that cup of coffee or just even the beauty category. Beauty continues to outperform here. And that is what is typical of a time where consumers are pulling back on some of those discretionary dollars. Beauty tends to outperform, and even things like, that $7 Starbucks cup of coffee you might be getting as well.
Yes, we continue to see food service and drinking places up 0.6%. So obviously I was looking at the wrong column. I was looking at year over year, but directionally similar sentiment here. Gasoline stores, autos down, electronics down, furniture and home furnishings down, up. Food and drinking places, as I mentioned. Non-store retail stuck out to me as well because that is sort of code for Amazon and the sort of pure play online retailers, which is interesting given what we heard from Amazon about the first quarter. So still seeing some spending there. The biggest percentage drop, it looks like month over month, was in sporting goods, hobby, musical instrument, and bookstores.
A few companies that this is not good for. Sporting equipment, especially if it's in the store category. Dick's Sporting Goods. Company like Peloton even. That
maybe Topgolf, we just heard, had a bad quarter. Sorry.
Don't hit my Topgolf like that. Okay. Well, yes, it's true though. And then on the other side of that, you think about where, and in those declines, the other one that you mentioned a moment ago that was escaping me for a hot second here, but even across the clothing and clothing accessories, that is something to continue to look at even as we get into the Foot Lockers of the world later on this week, actually. And then even as we begin to hear about some of the other manufacturers of those goods, the footwear and apparel, even though one company that we're going to talk about later on, they actually had a standout quarter and that was on. We'll talk about that a little closer to the bell. But all of these things considered, I think the way that consumers tend to purchase, especially as they're looking across the dollars going out of the household, it shifts back to a lot more comparison shopping in an environment like this. Given that they've heard the word recession now for the better part of a year, it's likely that more consumers on that e-commerce or digital spending side that you were mentioning a moment ago, they're looking to see, okay, where can they get the best deal? And that leads them back into a lot of the digital landscape and the digital shopping trends that we've seen.
Yeah, that's even year over year, grocery store sales are up, but month over month down 0.4%.
Oh, wow. Yeah. All right. Here with a deeper dive on the market direction following the latest economic indicator, we have Quincy Crosby, LPL Financial Chief Global Strategist. Quincy, great to have you here with us this morning. First and foremost, you see data come through like this. Where immediately does that pivot your attention to?
Well, you look at it, but you also see that Americans are traveling. And we know that ticket sales have been higher, and yet the planes are filled. We've heard from the airlines. So perhaps what we're seeing is that Americans are being more cautious. They are budgeting accordingly to what they're going to be doing over the summer, and we see that they're traveling. We also interestingly heard from Disney. Now that was disappointing, but one of the things that Disney did mention is that Americans and globally visitors to the parks. So that's an expensive endeavor. And many Americans, if we're just looking at the U.S. Data, plan for that well in advance so that they're going to cut elsewhere. But you nailed it. I mean, when you keep hearing recession, even if you have a job, you're beginning to wonder by hearing this over and over again, when is it going to hit you? When is it going to hit your family? So again, Americans are being more careful and more judicious in how they spend. We're using our credit cards, and that's something that is, being circled right now because we're seeing late payments picking up, not so much delinquencies, but late payments and credit card payments, and also auto loans, late payments. So all of this points to a slowdown. But when you have an unemployment rate at 3.4%, it's hard to envision that a recession is just around the corner.
Well, and we'll get more information, of course, on that front when we get Target, Walmart, some of the other retailers. The initial read from Home Depot, does that give you pause? I know obviously it's very different businesses and products, but still, what does that sort of initial blush tell us about how consumers are doing?
Well, it is concerning because if we remember, Home Depot would always be the earnings report that basically said, oh, everything is okay, everything is fine. So to hear from them that there, was a slowdown, although the weather-related issues are real, but it is concerning because, again, we know that consumers are slowing down. We know that we're using our credit cards more and more. One thing about the Home Depot numbers, I didn't hear this because I haven't been on the call, obviously, is what are they doing in terms of employment? Remember, they introduced higher wages. They said, we're preparing for the future. We need to do it now. The question that I have is this going to lead them towards cost cutting in terms of their staff, and also, again, having to pay for those higher wages that they introduced just recently?
Yeah, that's a really good point, Quincy, and we'll be listening to the call, which, as I mentioned, is happening right now. We'll be listening to them from the other retailers, too.
Yeah.
I want to ask you, from consumer sentiment to investor sentiment, we showed this chart a moment ago, the Bank of America Fund Manager Survey that they conduct every month showed that investors are the most bearish that they have been yet this year. You see the big decline there in investor sentiment. Of course, this can be a contrarian indicator. Where are we going from here, Quincy? We're heading into debt ceiling talks, what's going to happen with the Fed? Are they indeed on pause, et cetera? What's the sort of setup going into the summer?
Well, there's concern. We know that the market itself has been in a tight trading range. And we also know that there are just a handful of stocks keeping this market higher, and they are in the big tech names. So that's a concern insofar as a healthy market has a much broader representation. That's something that we would like to see. But as we go through these data releases, and we have a host of them, and we have a litany of Fed speakers, I don't think I've seen this heavy a program of Fed speakers wondering what their message is. Sometimes they come out with a definitive message. And the question that I have is, are they telling the market, stop talking about the rate cuts that are coming in, September of 2023? I don't know, because we haven't heard as many. But there is a question, because we are seeing the probability for a rate hike in June tick up. Now, it's not dramatic, but it is ticked up from very, very low levels last week. So that is a question, and that is something I think that the market is most concerned about. The market overall does think that we're going to see a deal come out of Washington, even if it's a temporary, as they say, temporary default. But overall, there are concerns that there are remnants of inflation left into the economy. And the question is, does the Fed feel that it has to stamp it out now before it turns into a stagflation underpinning. This is something that is of concern, but the question is, what is the Fed going to do? Because it is a split Fed now, and Federal Reserve speakers are coming out with their opinions. But we're going to see Bernanke and Powell at the end of this week, and that's going to be incredibly important, as will Walmart and Target, as you pointed out. The consumer is spending, that is still good, right, but it is all predicated on 3.4% unemployment. And that equation has not been ripped apart yet. It's still a solid equation.
Right. And when we heard Cleveland Fed President Loretta Mester this morning saying that the data is showing U.S. rates are not at a sufficiently restrictive level yet, to your point about all this Fed speak.
Exactly.
Quincy, got to leave it there. Quincy Crosby, LPL Financial Chief Global Strategist, thank you so much. Really appreciate your time this morning. We've got investment news from Berkshire Hathaway. Warren Buffett's company making a big bet on Capital One Financial, disclosing a $954 million stake on late on Monday. The shares are up about 3.2% today. At the same time, Berkshire exiting regional banks amid the recent turmoil, shedding its remaining shares in Bank of New York Mellon and U.S. Bancorp. Those shares, though, are trading higher here this morning. This is something that he had talked about a little bit at his shareholder meeting. This all coming out, though, in filings that were released late yesterday. Executives from Silicon Valley Bank and Signature Bank, meantime, will testify in front of the Senate Banking Committee at 10 a.m. Eastern about the failures of their institutions. And we'll talk to Rhode Island Senator Jack Reed. That's at 9:45 a.m., just before he heads into those hearings.
Time now for today's morning brief, where we're checking in on the financial sector. If the bank failures since early March was not enough stress for financials, debt ceiling negotiations, they've added a new wrinkle of worry. The already challenged sector is down over 6% year to date. And after a turbulent few months, investors become more focused on the added concerns for banks. Debt ceiling mentions in the financial sector have risen over the past months, according to RBC Capital Markets. Now, this comes as executives make more noise on risks surrounding the debt ceiling debate. Compared to other sectors in the S&P 500, financials lead the way with the most mentions of the debt ceiling. Financials speak on the matter twice as much as the next concern sector, industrials. While past times point to Congress always resolving debt ceiling negotiations, investors' concerns they grow as the deadline of a default that nears. We spoke with RBC Capital Markets' Lori Calvasina yesterday on how past debt ceiling drama has hit markets, and here's what she had to say.
If you go back and look at every debt ceiling drama since 2011, you've gotten at least a 5 to 6% hit to markets before Congress has gotten around to acting. In major drama years like 2018, 15, 16, 2011, where there was a lot of other stuff worrying investors, those hits have been more like 10 to 19%. In my mind, we're looking at something potentially like a 5 to 10% hit if Congress really doesn't pull things together soon.
With more on what debt ceiling negotiations mean for markets, we've got Katie Kaminsky, Alpha Simplex Chief Research Strategist and Portfolio Manager. Now, Katie, we could be surprised to the upside. Maybe there's some massive breakthrough that happens later today, but I think that's highly unlikely as of right now.
Yeah, I mean, I think the challenge with these type of discussions is that they're very low probability events that have huge impacts. And I think when you think about the banking sector, I mean, they're clearly right in the thick of it. If we were to deal with a default or even a technical default, clearly it's going to be the short-term obligations and things that they're holding on their balance sheets that are in front and center. Hence, it's clear that that sector is the most affected by that. We'll have to see. I mean, I think guessing from my perspective, it's going to take some time to figure out.
Is this a situation where you're putting on any hedges to sort of prepare for, I mean, there are different scenarios that you can prepare for, right? You can prepare for stocks falling in advance of the deadline and then forcing the hand and an agreement coming. You can game out stocks falling and then them not coming to an agreement and then falling more, right? Are you sort of hedging against those various scenarios?
So this is where the point that this is such a rare event scenario, it makes it difficult to hedge because it's such it's so hard to estimate the probability of this type of event and the agreement of different parties that I think in the financial markets, you're seeing a little bit of indication of moves in equities. You're seeing some momentum signals moving towards short signals in equities, but then bouncing back again. So I think in general, it's very, very hard to hedge something that's this extreme in terms of how large of an outcome with such a low probability. So I think from our perspective, most financial investors are really waiting to see more information, and that's why you see markets aren't going anywhere.
What would be the piece of information that would absolutely just put wind in the sails of investors?
Well, I think the challenge here is we'd have to see a resolution. And I'm sure when we see a resolution, then we'll move on to going back to thinking about inflation, worrying about regional banks, and wondering if a recession is coming. So I think the sad part is it feels in some sense that the debt ceiling discussion is more just another thing to worry about. And there's really no silver bullet of something that we can find that's going to kind of make conditions change. I think we need to see inflation back down to target levels, because today's retail numbers basically show us that the stress and this unsustainable impact of inflation is affecting the consumer. How long is it going to take? I don't know.
And so if that's a question, I mean, nobody seems to know, least of all the Fed, right? How long that's going to take. I mean, I mentioned earlier, we heard from Cleveland Fed President Loretta Mester this morning saying that rates are not at a sufficiently restrictive level if you're looking at the data right now. So that, doesn't give a lot of credence to the idea that the Fed's going to be cutting sometime this year, certainly.
I agree. And one of the challenges, everybody's looking for Fed cuts. They're thinking, oh, wouldn't it be great if we had rate cuts this year? And what I think is hard about that is you have to think about what we'd have to see for the Fed to cut. And honestly, it would have to be deterioration in financial conditions to a level that's even worse than the concept of the rate cuts themselves, in my opinion. And so I think the better thing to think about is it's really a period where we've had a lot of monetary policy. It's a blunt tool to deal with the inflation problem. It's going to take time and data to figure out how long it takes to cool down inflation, which is not an easy thing to deal with. And as we move through that, we're going to have to wait and see and hope that we don't have an overstep in policy such that we end up with a cycle, like a deflationary cycle or recession, that causes us to lose some value later this year. And I think that's what everyone's afraid of, to be honest.
Well, we're going to talk much more about that. Katie Kaminsky, hang around. Alpha Simplex Chief Research Strategist is going to stay with us as we continue this discussion and look ahead to the opening bell. And speaking of which, heading to the Hill, we're going to not finish this regional bank turmoil discussion. Attention turns to Washington, D.C. as former execs from SVB and Signature Bank face the fire. All of that coming up ahead. The stock and bond market cannot seem to agree on whether a recession is going to hit the economy. The stock market seems to be pricing in a soft landing. The bond market's expecting an economic recession and maybe rate cuts by the end of the year. So we were just talking about which one of them is right. Katie Kaminsky is back with us for the conversation. Katie, this is tension that periodically comes to the foreign markets. This year, though, it's definitely been there. So we were just talking about, it seems like you think that maybe the stock market's going to be right on this one. What do you think?
Oh, yeah, this has been hard. Last year, I love this question. Honestly, if you look at the markets today, you see equity markets are still kind of hopeful. They're thinking things are going to be okay. They're looking for the soft landing. We're hoping for cuts. They're sort of hoping that we can navigate a difficult scenario. But bond markets are really still looking difficult. They're saying we have an inverted yield curve. What does it mean to have a Fed pause with an inverted yield curve? And thus, the bond markets are really significantly suggesting that either bonds are not priced correctly, or we're going to see some sort of recession. I personally I'm hoping that the stock market is right, but I think bonds are often underestimated by investors. They think of them as just safe, and they don't realize that in this type of environment of inflation, bonds are what you need to look at. That's what happened last year. Last year, it was the bond market that led the way, and it told us what was really happening. And the equity market was sort of just bouncing around. I don't know. What do you think, Julie?
I don't know. I think that the people who are betting that we're going to see a cut before the end of the year, the Fed has effectively said we're probably not going to cut this year. They haven't said it in so many words, right? But I think that I don't know. I don't know either. Katie.
Well,
the bottom line.
Yeah, believing that we're going to cut by the end of the year. That's there have already been. Muro was out early on saying that we were going to see a cut at the last meeting, and we all know how that played out. But the larger kind of implications of if we were to see a cut or a massive pivot by the Fed, would that signal that there's something else so dire within the data that they're saying that they just have to pause?
Exactly. I think that's what people don't realize. It's not that we're going back to the old normal. In fact, we've moved to a new normal where inflation is so much higher. So inflation has come down, but it is not low. And I think what's interesting today with the retail numbers, it tells us that at some point, it's not sustainable for the investor. It's not sustainable for the consumer to have higher costs. And then we have to see what happens next. And I think that's why this market, if you talk to anyone in this space, is challenging, because it doesn't seem to be clear who's right. Is it bonds? Is it stocks? And we have very blunt monetary policy tools to deal with this issue. So I really think it's going to take a couple more months to see.
And we know investors are not super patient a lot of the time either, do we, Katie? Hang on just a second. We got the opening bell coming up in about a minute here, and futures are pointing now to a lower open. It looks like they kind of rolled over once we started getting the likes of Home Depot, then the retail sales data as well, because to Katie's point, a lot of this data, rather than clarifying the picture, just muddies it further and makes it more difficult to say, right? So consumers are spending on some stuff and not spending on other stuff, right?
Yeah.
Clearly, they're not spending as much at a place like Home Depot, right? They're not spending as much on gasoline in part because prices have come down. So there's a lot of different tendrils to pull out here.
Yeah, the mention of softening of demand specifically for Home Depot, I think is something that we could hear show up in the rest of the retail earnings reports in one facet or another, whether it's necessities or in some of that discretionary category, even for a company like Walmart, which, yeah, you might get your groceries there, but you're also not buying as much apparel there right now, according to this data.
Yes, well, and that's what, according to Walmart itself, right, that's what we've been hearing in recent quarters. We don't know what we're going to hear from them this week, but that has been a trend certainly at them and at Target as well, that people are leaning into the grocery aisle and necessities and not necessarily buying as many of those discretionary items. There you got the opening bell on Wall Street on this Tuesday. Let's do a quick check of the markets here now that the bell has rung, sponsored by Flex Shares. And we do have this push lower across the board. We'll see it in the Nasdaq when it opens up in just a moment. But all three major averages not seeing a big decline here. But nonetheless, futures have been bouncing around a little bit this morning before now this lower cash open. All three averages down about a quarter to, in the case of the Dow, about 1/4%. So the focus, not just today, but all week, as we've been talking about, is going to be on the consumer. And the early indications, especially if you look at Home Depot, not great.
Yeah, well, we're taking a look at the Dow Jones Industrial Average here. Out of the gate this morning, you're seeing that lower, as Julie mentioned, by about 0.4%. We'll round that off to Nasdaq Composite, also in the red by about 0.25%. Past 2 days, though, still holding on to some slight gains, fractionally higher by about 0.4% there. S&P 500 flat, about as flat as it gets, holding on by a hair of its chinny chin chin to the upside here. Over the past 2 days, but here today it's down by about 0.25%. So let's take a look at the S&P 500 sectors, as we always do, just to start off your trading session. 11 sectors, we've got them loaded up here for you on the screen, pulling up the caboose. Consumer discretionary here, and think about some of those categories that we were talking about with regard to the retail sales data that came out this morning. Consumer discretionary, that's down 0.8%. Staples actually even down by about 0.75% this morning. But look at technology. That's actually the lone gainer, the Lone Ranger in the green. It's up by about 0.1%. Speaking of technology, let's take a look at the Nasdaq 100 here. Some of those mega cap tech stocks trying to put the team on its back in a sea of red. You've got some green among the largest of the companies here. Microsoft, fractional gains there out of the gate. That's up 0.7%. Google, Alphabet, Alpha Google, whatever you're calling them, call them in the green. And Nvidia, the chip maker, you're seeing that higher by about 0.2%. Plus 0.2% gains for Apple and Amazon, just a little bit more than that as well.
Yeah, we've yet to get those Nvidia earnings too.
Right.
That's the last of the biggies. I think we have retailers on
We do.
our heat maps somewhere there. You might need to go to a different list of them. We got a lot of heat maps, but I'm curious to, as we get underway, there they are. HD down 3%. Lowe's looks like it's getting pulled down too.
And look at this, kind of previewing what we're going to be waiting for later on this week. Of course, Walmart, you're seeing that down by about 1.5% right now. Target also lower by about 2.9% on the same day as the retail sales data coming out this morning. And even into some of the dollar store retailers, those are interesting to track, especially when consumers are looking for more of those discounts or looking for some type of deal wherever they can find one. Let's zero in just very quickly here on Dollar General and Dollar Tree. Dollar General, you're seeing that down by about 1.2% even right now. And then additionally, Dollar Tree, that's down by about 1%. So largely red across the board. Amazon, the only company on this board, well, not the only company on this board that's already put earnings out, but one of the only retail companies on this board that we've heard from earlier on in this season.
Yeah.
Because, well, it's a big tech company.
Yeah, and retail sales showed that non-store retail actually went up. So let's get some other movers that we're watching on this Tuesday morning. Shares of Capital One rallying after filings showed that Warren Buffett's Berkshire Hathaway took a nearly $1 billion stake in the company, buying 2.6% of the shares in the first quarter. This as Buffett dumped shares in Bank of New York Mellon and U.S. Bancorp. Now, this is something he had sort of talked about that he was doing here. My caveat or my disclaimer, whenever we talk about 13F filings, they are a snapshot of one day. Now, Warren Buffett, as we know, tends to buy and hold stakes, but we also don't know what's on the other side of the equation. Right. Is he shorting? Is he hedging? Are there things he is not disclosing? So it doesn't give us necessarily a full picture of what's going on, but it does give us a little bit of an insight into what he is doing.
Yeah, we, even as our discussions ahead of the show, it was pointed out by our team that, yeah, this is also one of the largest lenders on a financial basis for auto purchases. Auto purchases here, especially for Warren Buffett's Berkshire Hathaway, they have already taken another stake. Last year, they took a stake in Ally Financial, and that one of the other large player in autos. So within that kind of lending capacity, it'd be interesting to see where they perhaps are looking across the automotive landscape and where for some of the loans that both Capital One and Ally Financial, where that is appetizing for them to add on to their portfolio right now.
Yeah, I want to bring Katie Kaminsky back into this discussion because I think the regional bank discussion is still so interesting. Is that an area where you're looking at either banks broadly, regional banks specifically? Because it feels like there are a lot of headwinds still to come in this group.
Yes. I mean, I think this comes back. What I love that you're talking about Buffett here right now is he's a value investor. So they're looking at companies where they see value over the long term. And we got to remember they were very successful back in 2008 and sifting through the rummage in a very extreme financial environment. But what's interesting now is really the fixed income angle of this and which of these banks are the best positioned to deal with a very different rate environment. either inverted curve or as we see yields might be moving and we see capital rolling over and people trying to refinance it, I think that's where the interesting opportunities come in the space, is figuring out which banks are going to be better positioned to move as sort of capital costs have changed significantly, going through sort of this tightening cycle that we've been through right now. And we've already seen that there's trouble in the waters with what happened earlier this year. And so the question is going to be which other banks are better positioned to move with the situation and which of them are going to have more challenges, because perhaps they're in an area, like you said, autos that is better, or another area which is going to have more challenges.
Yeah, absolutely. Katie, we got to shift gears here a little bit. Just after the opening bell, Katie Kaminsky joining us this morning for all things discussion, wide-ranging, I might add, debt ceiling all the way into Fed policy. Katie Kaminsky of Alpha Simplex. Thanks so much, Katie.
Thank you.
Also here, a deal in jeopardy. Shares of Horizon Therapeutics, they are falling sharply this morning after Bloomberg reported that the Federal Trade Commission was planning to sue to block Amgen's $28 billion purchase of the drug maker. Now, Amgen responding to Yahoo Finance saying that they are not aware of any decision made by the commission. They also acknowledge that they are going to provide any appropriate updates when more information arises and comes. But here's what you do need to know about this. This deal was announced back in December of 2022 here, and ultimately this was kind of kicking off, or at least a bond deal was moved forward also to try and make sure that the acquisition could be financed at the end of the day.
Yeah, so this raises a lot of questions about the FTC because these do not have overlapping areas of treatment. They are both working on treatments in some overlapping areas. But Lena Khan of the FTC has said in the past, as antitrust enforcers, it's our job to promote drug company competition that will help create the right conditions for the next generation of scientific advances. So this is sort of the first test within pharmaceuticals. It raises questions about whether there are going to be other antitrust challenges. The FTC lately has been quite active in throwing up roadblocks to acquisitions. I was just looking at some research this morning. Michael Yee, friend of the show, over at Jefferies, saying he thinks that the deal is still going to get done after a speed bump here, but that the FTC and the current administration is continuing its more aggressive strategy to deter M&A. So it's interesting here as we watch. You know, this isn't just specific to this company. It's part of this bigger story about regulatory attention on what they say are antitrust challenges here. And especially in an environment where valuations for some companies might look a little bit more attractive, and especially in the broader deal-making kind of construct that we've seen in this cycle, at least, for healthcare or biotech plays, and where there are different treatments, where there are different overlaps between where they would just like to be able to add on more licenses or patents to operations that they already have, knowing that so many of the existing patents are about to start rolling off over these next 2 years. So now they're trying to safeguard what their revenue base looks like. Yeah. Some acquisitions have come forward and quite quickly as well. And so it'll be interesting to see how the FTC continues to case-by-case basis in an industry that's going to see even more of the attempts to consolidate and to safeguard for investors and for their own revenue base and how they've scaled, how they look at each of these acquisitions as they do come forward as well. Yeah, and one final note, again, Michael Yee at Jefferies says that he expects Amgen will go to court against the FTC. Mm-hmm. And so this will prolong the deal closing process. It was supposed to close in a couple of weeks, but he thinks ultimately they'll prevail. All right. We'll see. We are going to watch that one continuously here. Also, running full steam ahead. Popular Swiss running brand On Holdings starting the fiscal year with another record-setting performance. The company posted record revenue, a whopping 80% increase in sneaker sales, and boosted its full-year guidance. Despite all of that, shares, they were lower this morning here. They were higher pre-market, so interesting to see them now reverse course and be down by about 8.5% here. What is also noteworthy here, gross profit margins, increased to 58.3% from the 51.8% that they had seen last year. Net income margin, that increased to 10.6% from about 6.1%. And I think for a company that
is in this broader conversation that we've had with New Balance and their CEO, Joe Preston, as well as the CEO of Brooks Running, who Sazi just saw out at the Oracle of Omaha and Warren Buffett and Berkshire Hathaway's annual meeting. They've said that running is recession resilient right now. And because it's one of the easiest forms of exercise that people can get into as long as they can get into an affordable shoe. Now, On is one of the kind of more premium tiered shoes out there, but to see them still doing well, at least in this most recent quarter, I think that signals where some of the athlete activity or purchasing patterns might still be holding strong right now, too.
Yeah, I guess so. Although lifestyle, they've got an increasing lifestyle business, too. One note as we watch the stock decline this morning, the shares have almost doubled this year. Remember, they came public back in September of 2021 at 24 bucks a share, and they're still trading well above that level. They've really surged in the past few weeks, in particular, back above that IPO price. We should mention the co-CEOs of On Holding, Martin Hoffman and Mark Maurer, are going to join Yahoo Finance tomorrow in the 11 a.m. hour. We're going to dive much deeper into these numbers in an interview you don't want to miss.
And coming up, Rhode Island Senator Jack Reed joins Yahoo Finance to preview his line of questioning to failed banking executives from SVB and Signature Bank. That's next.
Executives from Silicon Valley Bank and Signature Bank will testify today about the failures of their institutions. They'll be doing that in front of the Senate Banking Committee. 4 U.S. banks have now failed since March, starting with crypto-friendly Silvergate back on March 8th. SVB's former CEO Greg Becker will testify today that the failure of Silvergate and previously reported links between the banks caused what he says are rumors and misconceptions to spread quickly online, leading to a, quote, unprecedented bank run. Investors tried to withdraw $42 billion from SVB on March 9th, another $100 billion the next day. Becker writes, quote, I do not believe that any bank could survive a bank run of that velocity and magnitude. Joining us now, Rhode Island Senator Jack Reed. Senator Reed, the most senior Democrat on the Banking, Housing, and Urban Affairs Committee. He'll have, of course, the opportunity to question those bank executives. Senator Reed, thank you so much for being here.
Thank you.
Looking at that opening statement from Mr. Becker is quite interesting because it suggests that the bank run happened out of nowhere and nothing preceded it, where clearly there had to have been some precipitating events. What's going to be your main question for him?
Well, I think the bank was poorly managed, and the managers should be responsible for their poor leadership, poor management, and it should be exposed today, pointed out. This was a bank that had been repeatedly warned by the Federal Reserve that they had problems, but they dismissed those problems. This was a bank that did not have a chief risk officer on the premises, if you will, for at least a year before the collapse. And this was a bank that had 93% of its deposits uninsured, above the $250,000 limit. So this is an example of people who told us years ago, don't regulate us, we're smarter than you are, who turned out to make some very foolish mistakes.
Senator, the committee has seen 3 of the 4 largest bank failures in history take place this year. Does the committee believe that the banking crisis is over?
I think we are carefully watchful of what's happening in the market. I think we can't assume that there might not be a repetition. But what we're seeing, I think, is these institutions that fail were outliers in some respects. SVB catered to a very small group of Silicon Valley entrepreneurs. They had a huge amount of uninsured deposits. They only had 14 branches. This was not a consumer bank. This was a specialized bank that was not aware of, apparently, the dangers they ran, or if they were ignored them. And I don't think that applies to the majority of major regional banks, which have multiple branches, which rely on deposits which are almost always or significantly insured.
Do you think Gary Becker should have to give back some of his salary, all of his salary? He talks in his statement about how there were some stock sales ahead of the collapse of the bank, ahead of the bank run, but he says they were routine. He didn't know about them. Regardless, because of what you say is this mismanagement, should he have to give money back?
Well, yes, I propose legislation that would claw back competition from institutions that fail, and it's clear that the failure was significantly attributed to the management. I find it interesting that these stock sales, which netted him $2 million, he was apparently unaware of, which I don't think most people would be unaware of a $2 million increment in their salary or their benefits. I guess he paid the same attention to the bank as he did to his own personal accounts.
Do you believe that coming out of this, there will be an issue for regional banks of being able to kind of just grow out their operations, be competitors with some of the largest mega cap banks, given that the mega cap banks are often the ones that are tapped to purchase assets at often fire sale prices after events like this happen?
No, I think they can. I think the vast majority of banking institutions, both regional and even very small banks, are well managed. They understand they have to be careful about the risks they assume. They have to understand the climate of inflation, of interest rates, and they've done so reasonably well. And I think you've seen in my part of the country, and Citizens Bank is our largest bank, and it's doing very well because it's extremely well managed. They pay attention. And I think that's the vast majority of the banks in the country.
I guess for the banks that don't pay attention, though, you do need those regulators, right? And I know that you have called upon bank regulators to examine whether we need to bring back some of the rules that were changed under the Trump administration to increase capital requirements for these mid-sized banks, right? Like an SVB, for example. What do you still need to hear in these hearings today, in other investigations, to let you know whether that is necessary?
Well, I think we have to get from the regulators, and I think Michael Barr did a very good job to examine the role of the regulators, and he was unflinching in his criticism. And we have to take steps to follow up there, too. I think within the purview of the regulators, they can change many regulations, and they think they might. One of the aspects I think that was really more important than some of the regulations was the chilling effect that the passage of the bill, and more importantly, the Trump administration had on regulators. They basically said, in many respects, you're wrong and the banks are right. And remember that. That's not a good way to regulate. I think changing the importance of and emphasizing the ability and responsibility of regulators to not only point out deficiencies, but to take corrective action or require corrective action is just as important. And I hope that's done.
Senator, this is an extremely busy day for you. Not only is this hearing taking place, but there's also still, the small debt ceiling resolution that needs to be pushed over the line. And how close are we to that finish line, or perhaps how far away at this point, and what's the hang up?
Well, the hang up is that I think my Republican colleagues are recklessly flirting with a default that will harm the country and the world economy. And they seem to be very cavalier about it. It's interesting. When Trump was president, we passed 3 debt ceiling extensions. And he, in fact, came out in 2019 and said, it would be reckless, in so many words, not to pass the debt ceiling without any strings attached. We did it. But now the Republicans are here and flirting with economic disaster that'll impact every American household and indeed the world economy. So I think what they've got to do is finally realize that, as we did, is that we should pass the debt ceiling, and then we can sit down and argue, as we do, discuss a budget that will meet their requirements and hopefully meet our requirements, and that we can get it passed.
In talking to folks on the other side of the aisle, Senator, do you think there are any prospects for a so-called clean debt ceiling to be passed, for those two things to be separated? How close to the brink do you think we're going to come here?
Well, unfortunately, I think we're going to be, we're already too close to the brink. We should have resolved this. We should have done this as we did under the Trump administration routinely. And frankly, it was done essentially with Democratic votes, because we understood, even as President Trump was president, the devastating consequences of a failure to pass a new debt ceiling. So I think we should move very quickly. I think there are many Republicans that understand this, but they are, I think, sort of standing back and letting McCarthy take point, if you will. And I think Speaker McCarthy is now subject to the whims, if you will, of a very radical group of Republicans, the 20, 30, 40, who are insisting that there's no problem with the debt default, and they want to really set back the economy of the United States and indeed the world. And we're in a difficult position, but I'm encouraged that there are people talking now, that the president is meeting with the speaker and other leaders today. Those talks will continue. And I just hope, and frankly, this is where Wall Street and the financial sector, which has the most really at risk, has to start standing up and more vociferously saying a failure to pass a debt ceiling, a clean debt ceiling, hopefully, would be catastrophic. And when those voices, not just publicly but privately, weigh in, that could make a real difference.
Senator Reid, we certainly do appreciate the time. I know you'll probably have to put on your running shoes to get on over to the hearing taking place, but thanks so much for taking some of this quick time here ahead of that hearing.
Thank you.
Absolutely.
Take care. Bye.
Stocks looking for direction in early trade amid a big miss for Home Depot and a rebound in retail sales. Let's get to the NYSE and Yahoo Finance contributor, Remy Blair. Remy, great to see you this morning.
Good morning. And as you mentioned, U.S. stocks have opened in the red. And although we saw a brief pop into positive territory for the Nasdaq, overall, there are concerns about retail sales figures as well as that disappointing guidance out from Home Depot earlier this morning. Meanwhile, overseas in China, we got a slew of economic data releases and we did get some double-digit percentage gains. But at the same time, they still came in weaker than estimates. Taking a closer look at the April data coming out from China, we saw retail sales rising 18.4%, industrial production up 5.6% year over year, and fixed asset investment up by 4.7%. At the same time, we got two readings in terms of manufacturing PMI out from China, but they both came in below the 50 reading. And moving on to company stocks, let's take a look at Baidu. Baidu reported first quarter revenue that did top estimates. Now, keep in mind that revenue rose by 10%, and this did come as businesses upped their advertising spend. Strict COVID restrictions were dropped in the end of 2022, and this was the first reading for the company following those lifting of restrictions. Although we did see gains for the company before the closing bell, we are seeing that stock hover near the flat line this morning. Now, I want to move over to Alibaba. The company will report earnings ahead of the opening bell here in the U.S. on Thursday, May 18th. Now, ahead of that, forecasts do call for an increase in EPS as well as improvement in revenue. This does come after the fourth quarter 22 figures did post an EPS miss. Meanwhile, Alibaba announced that it is splitting its business into 6 separate units, and the company says this new decentralized structure could save the company a whopping $1 billion before the end of 2023. We are seeing shares of the e-commerce giant trade on the near flat today, but following that announcement earlier this year in March, we did see Alibaba shares pop by double digits. And I do want to mention one thing. Money manager Michael Berry of the long short fame made a contrarian bet on Alibaba, and this is according to the latest 13 F filings that were released on the SEC website on Monday. Now, keep in mind that China's economy is still recovering, and its latest GDP figures gained by 4.5% earlier this year. So compared to the U.S., we are seeing upside in terms of economic data, but at the same time, it might not be enough to improve sentiment over in China.
Remy Blair, thank you so much. Appreciate it. We'll let you go say hi to some of the high school kids it looked like who were visiting the floor at the NYSE today.
Indeed.
Appreciate it. Well, coming up, our attention turns to key testimonies on Capitol Hill. First, former executives from SVB and Signature Bank face the Senate Banking Committee to discuss the recent failures and, more importantly, why they happened. And that's not all. There's another big hearing today, the AI debate arriving at the Hill. The Senate Subcommittee on Privacy, Technology, and the Law will get up close and personal with OpenAI CEO Sam Altman. Welcome back to Yahoo Finance Live. I'm Julie Hyman with Brad Smith. We're looking at the markets today that are down, but I'm watching oil prices as well. We just had an announcement late yesterday that the U.S. government was going to be buying more oil for the Strategic Petroleum Reserve. You see the intraday action, not huge here, up about 0.3%. But if you look at the 2-day, there you don't see a huge gain either. But still, oil's been trending above $71 a barrel once again. So that's something that I've been keeping an eye on. And we keep talking about the Fed here. We keep talking about what are the prospects for rate changes in the wake of those retail sales numbers this morning. Here's the 2-day chart of the 10-year yield moving up again today to 3.55%. So getting a little bit of a lift from these levels, even though, as you can see, it has come way down this year and back in this range below, or sort of bouncing around the 3.5% range is what we have seen on a pretty regular basis. Now, as we talked about, we're setting up for a lot of bank hearings today. If you look at big banks in today's session, we are seeing them down pretty broadly across the board. Not much movement, though, percentage-wise, except for, of course, for Capital One Financial, as we mentioned. Berkshire Hathaway revealing a new stake in that. On the regional bank front, we're seeing a little bit of a mixed picture here, but again, sort of trending to the downside. But the likes of Western Alliance, which of course has been one of the banks that has been beat up during this whole situation, it's up about 2.8% today. I'm looking on this screen here for PacWest. There it is. It is off about 0.5% in today's session, Brad.
All right, we're continuing to watch those regional banks as well as the reaction to retail sales this morning. Retail sales climbed 0.4% from March levels, but still falling short of Wall Street's estimates. How will this impact outlook? How will this impact outlook for the broader economy? Greg Dacko, who is the EY chief economist, joins us now. Greg, great to have you here with us this morning.
Pleasure.
You read through the data this morning and kind of industry by industry, or at least within the retail sectors, we should say, of purchasing for consumers. Some of these same areas still showed weakness that we had already heard about in earnings seasons prior, and even from some of the companies that are still set to report here. Is there anything that you kind of extrapolate from this report and say that the economy is in a better or worse place because of it?
I think just broadly speaking, first of all, it's important to understand that these data for retail sales are nominal data. So they are not adjusted for inflation. If you adjust for inflation, you're looking at a fairly soft picture when it comes to the U.S. economy and the state of consumer spending. We had a 0.4% gain in terms of nominal retail sales, but when you adjust for inflation, CPI rose about 0.4%. So that's zero, flat retail sales for the month of April. Core retail sales, when you exclude some of the volatile items, rose, but they rose very lightly. And if you look at the year-over-year trend in terms of real retail sales, they're down about 3% on a year-over-year basis. So you're seeing people essentially being much more discreet when it comes to their outlays. They're still spending more dollars because things cost more, but they're buying fewer goods and fewer services.
Are they buying fewer services, though, Greg? I mean, because these retail sales data don't include things like travel, right? They do include restaurants, food and drinking places. Those numbers went up, although I don't know what the inflation-adjusted numbers are. So how much of this can be explained by a shift in spend rather than an overall decrease in spend?
Well, I think the shift in spend, the relative shift in spend, is a story from 2022. We're really at the tail end of that shift in spending. The narrative that people are going out to restaurants and traveling more, that really the bulk of that took place over the course of the past 12 months. I'd be very curious to see how strong this travel season is going to be in a context where prices remain quite high. Again, even in this report, you only have food services as a service sector reading, and that rose 0.6%. So adjusted for inflation, it's a very small month-over-month increase that you're seeing even in the services sector. So yes, people are spending more on services. You do have this environment where wealthier individuals have more means to spend, and they're still spending on some of the services sectors. But overall, there is discretion that is being applied even in the services sector. The goods sector is seeing a significant pullback. The services sector, less of a significant pullback, but much more discretion being applied in an environment of high prices and high interest rates.
Well, even among some of the more wealthy consumers out there, I mean, I think back to some of the conference board data that we had seen about consumer confidence, and there's even been some moderation on the more affluent side of the consumer and where income levels are right now. So in that moderation and where that's started to trickle through to either the services spending or even on the product spending side, does that spell out that if we see the more kind of affluent or wealthier parts of the economy start to really pull back on spending, then, or at least put it elsewhere, who knows where that might be on an investment basis, whatever the case may be, how does that signal either a soft landing, a hard landing, or kind of I guess, a deeper recession?
Well, I think first of all, we're not seeing the type of traditional retrenchment that we see in the private sector whenever there is fear of a recession. You're not seeing any retrenchment in terms of business investment, in terms of the labor market, in terms of consumer spending. What you are seeing is a cooling, more strategic decisions being made, and increased elasticity. So people are more sensitive to prices. And as prices continue to rise, there is more of that demand reaction than there had been in the prior 2 years. What that means in terms of spending going forward is that we are going to see this cooling. What I'm fearful of is this environment where we're seeing growth gradually slow and the economy being more susceptible to downward shocks, whether it's the banking sector shock or the debt ceiling debacle that we're now going through. These are all increasing headwinds from a credit position, from a financial conditions position. Those are weighing on economic activity. And an economy that is growing at a 1% pace is much more susceptible to these headwinds than an economy that would be growing at a 3 or 4% pace. And let's remember, the Fed is not tilting towards a more dovish stance. It will maintain a fairly tight stance going forward. So that's less of a tailwind than usual whenever you have a slowdown.
That susceptibility that you're talking about, the delicacy, if you will, of the U.S. economy, is that in the economy itself? Is that a market's susceptibility to these downward shocks? And when you say that, there is this risk, what is that? How does that play out? What does that look like? What are the potential ramifications?
Yeah, I mean, I think the risk is on both sides, right? On the economic side and on the financial market side. On the economic side, we know that the real economy is slowing. We have seen a slowdown in terms of employment. Initially, it started with reduced hiring. Now we're seeing more and more layoffs. They're still not that significant relative to prior downturns, but we are seeing a softening of labor market trends. We're seeing businesses being more cautious with their investment decisions. We're seeing consumers, again, being more discreet when it comes to their outlays and being more cautious as to how they spend their money. That type of environment leads to a slowdown in economic activity. And then on the financial markets front, you still have a lot of concerns around the banking sector. You have a lot of concerns around what's happening with the debt ceiling in DC, and those are leading to a gradual tightening of financial conditions and credit conditions. And we know how important credit is in the US economy. So if you have credit starting to tighten and financial conditions tightening at the same time, that generally leads to a further hit to the real economy. And that's how this interplay can lead to a more pronounced slowdown on the economic front.
Greg, good to catch up with you this morning. Greg Dacko, EY Chief Economist. See you soon.
Cheers.
Our attention turning to key testimonies on Capitol Hill today. First, former executives from SVB and Signature Bank face the Senate Banking Committee to discuss those recent failures and, more importantly, why they happened. And that's not all. The AI debate also arriving at the Hill. The Senate subcommittee on privacy, technology, and the law is going to get up close and personal with OpenAI CEO Sam Altman. And on that latter hearing, let's bring in Yahoo Finance's Dan Howley. He's joining us now with the details. So what questions are we trying to figure out from Sam Altman here today? Or what do we think that Congress is trying to get to the bottom of here?
Yeah, really what's going on here is basically this is Congress saying we don't know what to do yet with AI, and we want to have these hearings and these discussions to determine just what kind of rules and regulations, if any, we should put in place. Now, some organizations like OpenAI and Sam Altman have said there needs to be some kind of guardrails put in place. We've seen the likes of Microsoft and Google talk about ethics in AI and how they're trying to put their own types of rules in place for this. And you could see there Senator Blumenthal giving his opening remarks in this hearing. Essentially, what you can expect is for the senators to go back and forth questioning Altman as to what we can expect from OpenAI, what we can expect from artificial intelligence, and what kind of technologies this could then lead to. There's been a lot of questions as to the authenticity or correctness of some of the responses that you get from the likes of ChatGPT or Microsoft's Bing, Google's Bard. They're known to produce what's called hallucinations, which is really just, making up seemingly correct statements out of whole cloth. There's a 60 Minutes interview with Sundar Pichai where Bard made up a book that doesn't exist. And so, these are things that do happen. And so this is something that they're going to have to discuss and kind of reconcile, where you allow the technology to move forward to ensure that you're getting the most out of it, while also trying to prevent the worst possible outcomes, which could be things like election interference, disinformation, misinformation, deep fakes, things along those lines.
Dan, while we've got you, since you mentioned Microsoft and OpenAI, we've seen some big investments in AI from names like Stanley Druckenmiller and David Tepper as well. So what can you tell us there?
Yeah, both of these individuals, obviously, big names in investing, but they're making moves into AI, specifically when it comes to the likes of NVIDIA and Microsoft. And those are two of the major plays that people are using to get into the AI space. NVIDIA, one of the big chip makers that's available that does produce the kind of AI chips that are powering this kind of new technology. And then Microsoft, obviously, with its tie-up with OpenAI exposed there and putting those technologies to work via its Bing and then its productivity services, security services, they're all getting that generative AI treatment. So, NVIDIA, one of the names, AMD, Intel still behind, but talking about AI. And then you have, essentially any technology company at this point, short of Apple, really, are talking about generative AI and the capabilities that the technology can provide. But, I think the biggest plays right now, at least as far as what I'm seeing, are definitely NVIDIA and Microsoft, and that's why you're seeing these investments being made.
Dan, thanks so much. We're looking forward to your continuing coverage here of the AI hearings today as well. Appreciate it. Let's take a look at a trending ticker that we're watching today. It's Vodafone. The U.S. shares, as well as the European shares, sinking after the company announced 11,000 job cuts over the course of 3 years. The British telecom company CEO said performance, quote, has not been good enough. After forecasting a decline in free cash flow for the full year, the shares off 9.5%. Coming up, a new development in the Jeffrey Epstein lawsuit. We'll have the details on which big CEO is getting subpoenaed now. Let's do a quick check of the markets now, sponsored by Flex Shares. All three major averages remain in the red. The Dow, which has been leading declines all morning long, is now down more, 0.7%. The S&P's off 0.4%. It's being led by consumer discretionary, and the Nasdaq off by 0.5%. Elon Musk is the latest to be subpoenaed in the U.S. Virgin Islands lawsuit alleging that J.P. Morgan aided the late Jeffrey Epstein's sex trafficking operation. The U.S. Virgin Islands calling on the Tesla CEO to report any communication between himself, J.P. Morgan, and Epstein. Yahoo Finance's Alexis Keenan joined us now with more details. And, this has been going on for a while. We've gotten all these subpoenas. What are the details on this latest?
Yeah, Julie. So this information, it comes in a new court filing from the U.S. Virgin Islands. And the government there is asking for Musk to turn over any documents he has related to the government's federal civil case that's filed in New York against J.P. Morgan, alleging that the bank aided the late Epstein's sex trafficking operation that involved minors by providing Epstein with banking services that allowed him and that he used to pay for recruiters in that operations as well as victims in it. Now, importantly here, the U.S. Virgin Islands gives no clear reason for targeting Musk here. They say only that upon information and belief, Musk is a high net worth individual who Epstein may have, and I repeat, may have referred or attempted to refer to J.P. Morgan. Now, specifically, the Virgin Islands government is asking Musk for, as you said, documents relating to communications. They want documents that they say would show communications between Musk and J.P. Morgan regarding Epstein, or documents between Musk and Epstein regarding J.P. Morgan. Also communications about any of Epstein's involvement in this trafficking operation. Now, Musk responded on Twitter last night, saying that this is idiotic on so many levels, that Cretin, referring to Epstein there, never advised me on anything whatsoever. The notion that I would need to listen to financial advice from a dumb crook is absurd. J.P. Morgan let Tesla down 10 years ago, despite having Tesla's global commercial banking, which we withdrew. I have never forgiven them, meaning J.P. Morgan Chase. That relationship is something that Musk has talked at length about, including in testimony in a Tesla shareholder case that concluded earlier this year. But Julie, back in 2019, there was some speculation that Musk has since denied, as well as Tesla has denied, saying that Epstein had given Musk some sort of advisement after he had come under regulatory scrutiny for that funding secured tweet. So far, though, J.P. Morgan has denied any knowledge of Epstein's alleged crimes. And so we will have to see where this goes. But certainly this subpoena looking a bit like a fishing expedition, at least right now.
So who else has the U.S. Virgin Islands targeted with the subpoena?
Yeah, so there was one about a week ago that the Virgin Islands was also trying to subpoena communication documents reflecting communications, that is, from Google co-founder Larry Page. So both of these instances, though, the government there seeming to have trouble reaching these executives. They're trying and asking for the court to allow it to use alternate means to subpoena this information. So the next step we would expect here would see a court's decision on both of those requests.
All right, Yahoo Finance's own Alexis Keenan following all things, of course, around the legal proceedings here that come to light. Thanks so much, Alexis. Appreciate it. And coming up, bank executives are testifying in the Senate over the failure of SVB and Signature Bank. But how did the crisis even begin? We'll break down that timeline for you coming up next. Executives from Silicon Valley Bank and Signature Bank are testifying right now about the failures of their institutions in front of the Senate Banking Committee. The banking turmoil began in early March and has since dominated headlines. On March 8th, crypto-friendly bank Silvergate wound down operations after taking dramatic losses following the collapse of FTX. On the same day, Silicon Valley Bank revealed a massive loss from withdrawals and plans to raise over $2 billion in capital to make up for it. The next day, there was a $42 billion bank run. And on March 10th, shares were halted and regulators took control of the bank. 2 days later, the feds took control of another bank in crisis, Signature Bank. Biden tried to reassure Americans, saying that the banking system is safe. But days later, Switzerland's Credit Suisse also started to crack, with shares hitting new lows. First Republic was also suffering, and on March 16th, 11 big banks rescued it with a $30 billion deposit structure. Now, in the meantime, SVB that filed for bankruptcy and UBS acquired Credit Suisse. Regulators then announced First Citizens Bank would acquire the bulk of SVB's assets. But more trouble was brewing for First Republic, and the bank released a statement saying it was, quote, pursuing strategic options. About a week later, regulators seized First Republic, and the bank was sold to JP Morgan Chase. In the last couple of weeks, the fallout from the crisis has stayed with us. Shares of PacWest dropped on May 4th on reports of a sale, and shares stayed in the red on news that the bank lost nearly 10% of total deposits. Today, regionals, they're mixed right now. However, as this hearing goes on, it'll be interesting to see where that tick-by-tick action continues to move, Julie.
Yeah, and especially since the focus now has turned towards regulation, maybe the banks will actually get a little break. We'll see what ends up happening. But the hearing is underway for those bank executives, also for regulators. To help break down the implications of the crisis, we're joined by John Heltman, American banker, Washington bureau chief. John, good to see you again. Obviously, it's a pertinent day to be discussing all of this. And I guess to sort of pick up on my last point here, it is some of the executives who are testifying today. There's also another hearing that is talking to the regulators. Those two tracks, what do you think we need to be paying attention to? Which is more important right now?
Well, how's this for an answer? They're both equally important, so watch both.
Good answer.
One with each eye on two separate screens. There is a common thread through both of these hearings, and that is that since the outset of this crisis, at the very beginning, Democrats and Republicans were kind of trying to figure out what they thought about all of this. And that has since, I think, somewhat solidified into two kind of counter narratives. On the Democratic side, the point here, what you are seeing here with this series of bank failures, is a failure of regulation, a failure of, an inability of regulators to adequately regulate because of some of the policies put in place during the Trump administration, and that's their line. Republicans, by contrast, have sort of solidified around this idea that it is the regulators themselves that are institutionally unable to regulate banks, and so it's the regulators' fault. And new regulations or overhauling the regulations to make them more stringent on mid-sized banks would not be helpful, would not have prevented this crisis. And I suspect that in both of these hearings today, you're going to be hearing basically like reiterations of those dual tracks.
Has the flight of deposits stabilized from your perspective?
Well, the regulators certainly seem to think so. Janet Yellen had comments out this morning at a speech saying that the contagion risk is contained, that deposits have stabilized. Regulators in their prepared testimony for the hearing this morning saying similar things. Now, they also are saying that there's some risks out there in commercial real estate, potential credit risks, credit write-downs there that could affect regional banks and smaller banks. But yeah, so there's the deposit flight seems to be over. It seems like there aren't any other SVBs out there that have enormous reliance on business accounts to make up their deposit base. You have those that rely more on those are seen as more risky. You mentioned PacWest. That's kind of the next one in line. Western Alliance, similarly. So we may see still more failures, but those banks aren't really on the order of size that SVB or even Signature was.
I mean, as we talk about the so-called idiosyncratic features of the various banks that failed, right? Whether it was in crypto, whether it was in relying on startups, or sort of the balance of business, that hasn't been something historically that has been regulated at all, right? In other words, the sort of the type of businesses that a bank caters to. And it doesn't seem like that's something that the regulators would consider, isn't it? Is it? So how do you sort of address those risks without directly addressing those very sort of specific things at those banks?
So the bank regulators, especially the Fed, but really all the bank regulators have regulation and they have supervision, right? So regulation is pursuant to a law, and it will say as part of so for example, in the Federal Reserve's guiding light is the safety and soundness of the banking institutions they regulate. They can pursue or push a regulation saying you can't do this or you have to do that, and that applies to all banks equally. They also have something called supervision, where there is somebody looking over a banker's shoulder and saying, "Are you sure you want to do that? Is that a good idea?" And if they do it anyway, they can issue something called a matter requiring attention or a matter requiring immediate attention, which then goes to the board and sort of forces a decision. Now, some of the concern, again, from the Democratic kind of line of argument here, is that in the prior administration, there's this emphasis on not using supervisory actions to sort of act as de facto regulation, right? And that's something that I think Democrats are going to try to push back on. But to answer your question, there's lots of things that bank supervisors can do to tell a bank, don't do this or do more of that. For example, if your deposit concentration is way too high in one particular sector, that might be something that they would get dinged for. A bank would get dinged for now that they wouldn't have before.
There's typically more theater politically here on events like this than there is on 42nd and Broadway, especially on these occasions. So how can regulators signal not just to banks that they've got a firm understanding about what they need to do, but also to the broader public that they're acting in the best manner for the broader system at whole?
Well, they can just say those exact words and let lawmakers kind of question them. That's part of the point of this exercise of bringing the regulators out, bringing the banks out, or the bankers out to kind of call to account for their actions. Now, the regulators have been up to the Hill a few times, and they're going to be up again. So the regulators are in the House today, bankers are in the Senate. Tomorrow it's bankers in the House, and then Thursday it's regulators in the Senate. So everyone's going to get a taste. And I think at this point, especially the FDIC put out its proposal for how to replenish the deposit insurance fund last week, which placed most of the onus on the biggest banks to repay that loss that was incurred during the failure of Silvergate and Signature. It invoked something called the systemic risk exception, which means that they would insure uninsured deposits at a loss to the deposit insurance fund, or the DIF. And then they're also then required to do a special assessment to refill, to sort of replenish those losses. And during the board meeting, the FDIC board meeting last week, during that proposal, Republican board member Jonathan McCarthy sort of took exception to the idea that the biggest banks would be paying for this. I would be interested in seeing if any Republicans sort of follow that line of argument during either the hearings today or later this week.
John, we're going to continue to keep a live look on this up for some of our viewers as much as we can. But we got to wrap things here for today. John Heltman, who's the American Banker Washington Bureau Chief. John, always a pleasure getting some of your insights and coverage around this too. Thanks so much.
Thank you.
All right, talk soon. Guys, coming up, fixer upper much? Home improvement spending slumped in the first quarter. Home Depot feeling the hurt in a first quarter earnings report. And we've got more on that. That's coming up next.
Home Depot's first quarter was hit hard by declining revenue and sales growth as consumer spending on home improvement softened from its pandemic boom. The worst may be far from over. Home improvement demand is only expected to decline further in the year ahead. Here with what this trend means for the retail sector, Michael Lasser, UBS US hardline, broadline, and food retail analyst. Michael, it's great to see you because, man, this was quite a quarter and quite an outlook from Home Depot, and an unusual one for them, right, in terms of not only the numbers, but the commentary. I know there were some sort of specifics in here, but sort of writ large, what does it tell us about consumer demand, particularly for the DIY sector?
What it tells us about consumer demand for the DIY sector is that it's normalizing. After a period of outsized strength over the last few years, we are seeing that the consumer is shifting the spend to things like services, going out to eat, traveling, and that's having an impact on the consumption of goods. That's likely to continue for at least the near term. Now, the big wild card from here is whether or not the labor market remains stable. If the labor market declines from here, that's going to provide probably another leg of downside for the consumption of goods as consumers continue to pull back on their overall consumption trends. So it's something that is worth watching. But with that being said, right now the overall consumption of goods is seeing some weakness.
What does normalization mean for margin expectations for companies like Home Depot or Lowe's in that specific part of the retail environment?
So demand normalization for the home improvement retailers means that they are experiencing some margin pressure, and that's because sales are under pressure. What you would normally expect is that the deleverage associated with the fixed costs of this business on negative sales is going to create some margin pressure, and you're seeing that. There is a unique environment where inflation is moderating, and these companies have passed along significant cost increases over the last few years. So it's likely over time that will provide some margin relief. But for now, what's happening is margins are under pressure as sales decline.
Michael, got to ask you about lumber, right? Because that's one of the areas where we've seen lumber prices come down. And explain this to me, because I assume that that's a problem because Home Depot can't hold lumber prices up here if the underlying price is going down, because consumers won't. I guess they're aware that lumber's going down and they're not going to pay the same prices for it. Walk me through that.
Yeah, you're exactly right. Well, lumber is a commodity. So the prices change on a week-to-week basis, and the home improvement retailers pass along the changes almost on a real-time basis. So versus the same point a year ago, lumber right now is down about 64%. Now, normally what you would expect that when that happens, unit volumes will pick up. This is an elastic category, and if someone had put off building a new deck, as an example, because lumber had gotten so costly, that consumer might now think about restarting that project as lumber prices have come down. But what has happened this time around, lumber's fallen so fast that we have yet to see the unit response. That should happen over time. And from here, as we get into the second half of the year, the lumber prices will start to lap easier comparisons, and so the decline should moderate.
That said, though, isn't the margin on something like lumber consistent? In other words, does Home Depot, are they able to sort of peg it at the same gap on the way down, right? Their price versus what underlying lumber is?
That's right. Lumber tends to be a lower than average margin category. It's commodity, so it's very price competitive. And as a result, they tend to price to whatever the market's bearing at that time. So what actually happens is as lumber prices come down and this becomes a smaller portion of total sales, that's actually a good guy, because you have a smaller portion of your sales coming from a lower margin category. Now, over time, this tends to normalize, and it's not as much of a longer term consideration. But as you're rightfully pointing out, this can have some shorter term implications, and we're seeing that in the volatility as of late.
Michael, you began to touch on this a moment ago. Just kind of want to clarify, or perhaps ask you to add on to this a little bit more. where would you say that we are at in the DIY cycle?
I think we're moving through the middle stages of the DIY cycle. As you are probably well aware, the consumer had binged on the consumption of a lot of goods over the last few years in areas like patio furniture, grills, appliances. And so some of that is being pulled forward, and there's evidence of that now. At some point, we'll get to a base level of demand, probably in the next few quarters, and those categories will start to grow again. And Home Depot and Lowe's should be prime beneficiaries as the cycle turns. But whether that cycle lasts another 2 quarters or 8 quarters, it's really going to depend on the overall state of the consumer environment. And at this point, that's going to depend on the labor market.
One more thing I wanted to mention about this quarter is what Home Depot talked about on the weather front, particularly in California, seeing some weather effects and the hit to sales. How broad is that impact going to be for other retailers that have exposure in those geographic areas too?
So we're going to see some of the same themes that Home Depot talked about on its call across the retail sector, not only because of the weather impacts, and we've seen that already from retailers like Tractor Supply and O'Reilly, but also just the overall environment for discretionary spending on goods has certainly taken a step down over the last few months. And we expect to hear that from other retailers over the course of the next few weeks. The question is whether or not this is a temporary condition because tax refunds are lower, the weather, SNAP benefits have been pulled back. And so do we start to see an improvement as we get into June and July? Or is this just the new norm? Consumer is fatigued on all the things that he and she have purchased over the last few years. And as a result, we're entering the later stages of the cycle, and it's best to have cautious expectations on the consumption of discretionary goods from here.
Really solid insights always. Michael Lasser, UBS, U.S. hardline, broadline, and food retail analyst. Thanks so much, Michael. And coming up, everyone, a gym revival. We'll speak with the CEO of Planet Fitness as the industry gets a renewed push. That's next. It was an uphill climb for the fitness space following the COVID-19 pandemic, but the sector is bouncing back. Planet Fitness saw its highest quarterly net member growth since the first quarter of 2020, surpassing 18 million members in its latest report. Planet Fitness CEO Chris Rondeau joins us now live in living color here on set. Chris, great to see you.
Thanks for having me.
Absolutely. All right, walk us through some of the catalysts for this quarter. What really jumps out to you as the reason why you're seeing so many members come back?
Yeah, there's no doubt. Ever since COVID, started to pass us, there's definitely a undertone of people paying more attention to their health and wellness. We're seeing people work out more, cancellations are down, and the younger generations, millennials, and especially Gen Zs, are joining quite a bit faster than we anticipated as that generation rolls in. There's still about 5 more years left of them rolling in of age, but they're joining quite a bit faster than we ever expected. And today already we have about 9%, almost 1 in 10 of every Gen Z in the country is already a member. And in those other 5 years, I don't even have age to join yet, believe that. So, and millennials are already at 9% as well. So it's just a great trajectory we're seeing of them joining. And then you may have heard we just launched High School Summer Pass, which is where we open our doors to teenagers in high school to work out for free all summer long, no strings attached.
What's interesting about these numbers is not only are people joining, but they're coming a lot, right? Their frequency of visits is high. How long, when you see in the past people come and there's usually a burst of energy when people join, right? They want to work out a lot. What's the sort of attrition or stick with it rate usually of people when they do that?
Yeah, so how we look at it, and as we talk about the model a lot, we really cater to casual and first timers. So we're really not about the fit person getting fitter, right? We're trying to get people off the couch and introduce them to fitness, and at $10 a month, anybody can attain a membership. So we look at what happens after a year. If we can get you to stay a year, we feel like we've turned you into a full lifer, right? And after about that, it's about 2.5% to 3% a month attrition. But right now we're seeing better attrition today than we did a year ago. And even with inflationary costs of, while it's not going as far, we're actually seeing that better.
Wait, and how many people stick around for the first year? You said it's 2 to 3% after
we
that
don't really
year.
do it. Yeah, after the first year, we don't even watch it. We don't even track it. We just want to introduce you. And a lot of people fall off the wagon. But what we like is easy come, easy go. And 30% of our joins are rejoins. They come back. And that was 20% pre-COVID. So not only that, is they're coming back faster than they did in the past. So they're not choosing bricks and mortar. They're not choosing a home fitness. They're not choosing working out outside. They're coming back faster.
Yeah. I mean, it's well documented in our discussions in the past. I have been a Black Card member over at Planet Fitness. And the problem for me is that it is so easy for one to cancel it. However, it's also so hard for me personally to cancel it because I use it actually more when I travel than I do around the corner. So how, in terms of just making sure that people are getting the full benefits of whatever tier they decide to sign up for, and even upselling, say somebody comes in at the low tier membership, but they decide, you know what, later on I want to get up to a black tier membership even, or the highest tiers. What in that relationship do you typically upsell them on, and where are you investing further in those experiences to get more conversions towards that top tier?
Yeah, that's a great question because most people see us and know us as our $10 membership. Right. That's what we see advertised the most. And believe it or not, over 60% of our members walk in and end up taking the Black Card membership at point of sale. Once they understand the value of the Black Card membership, and to your point, reciprocity, use any club in the world, all 2,400 of them, no additional charge. And that's the most used. 1 in 5 workouts is not at your home club. You're visiting a different club. You have guest privileges. You can literally bring a free guest to work out with you every day. Different guests, same guest, no additional charge. Then we have our Black Card spa areas in the club. So you have access to tanning, massage beds, massage chairs. We're now putting meditation pods in these areas. And that's free use. If you're a Black Card member, you can use those amenities. And the new one is our Perks program. So in our app is we do partnerships with Shell Gasoline, Crocs, Blue Apron, Sam's Club. You get on the list. So if you're a member of Planet, you get discounts at these other partners. And if you're a Black Card member, some of those get bigger discounts. So we continue to add value, and that's what drives that Black Card acquisition.
Pre-pandemic, it really felt like there was an explosion in boutique fitness, right? In things like Rumble and things like Barry's, certainly that are very popular in urban areas like here in New York City. How much of that is competition for you guys? I mean, I know you said you sort of are targeting first-timers, people who don't work out all the time. So do you see that there's a lot of overlap there?
Yeah, I don't see them as competition at all. They're great exercise, but they're hard. First time has never done it, or maybe hasn't done it for 20 years since college. You're not probably doing that your first visit on a workout. And it is pricey compared to a $10 membership. So I don't look at them as competition. I look at them, they're kind of fighting over the same customer in their own world. People get bored with doing a CrossFit type class. They might do a cycle class. They might go to a rumble box, and they might go to a Pilates, and they bounce around. I do think I benefit in the fact that most of those type boutiques need reservation to work out. You can't just walk in and work out that day. You need to make an appointment. Now, if you can't get in, that means you don't work out that day. So I think I benefit from people who do memberships. Planet is your secondary membership. So if I can't get into a class today, you can go to Planet and get on a treadmill and do some weights. Yeah. And I'll take my Orange Theory class tomorrow. You know, so I think I benefit in the fact that, you know, we don't need a reservation. You come in 24/7 in most of our clubs, and you have 20,000 square feet of all the equipment you ever want, you know.
Even when there was such just wave of people who were looking at connected fitness devices and saying, I need to be doing more in-home fitness, at least either prompted by the pandemic or because they had made that purchase during the pandemic, and they had to continue to spend into or make sense of that purchase. You fast forward to now, 2023, where would you say that we were at in the cycle of in-home fitness as it correlates to where you're seeing people move back into that in-person fitness experience at Planet Fitness? Because you had also invested heavily in that digital touch point for a lot of end users or gym goers, even, if you will.
Sure. I look at, you know, any exposure to fitness is great for everyone, right? And I think I am still a beneficiary of that, you know, and I think people realize whether they give it a shot at home or they had to give it a shot at home because of COVID and now bricks and mortar opened. And let's face it, at-home fitness has been around forever. It's been around since Richard Simmons in the 50s and 60s, you know? But a real true bricks and mortar experience, if it's affordable, is going to far outweigh anything you have at your house. And that's if you have the room in your house to do it or you have the money to spend on apparatus. So, but I think also what digital fitness is good is it's good education, right? You don't need to hire a trainer to learn to work out and pay $100 a session. You can use your digital fitness in our clubs and use all the equipment and not have to hire a trainer. And we have a lot of content in our app and people use it in our clubs to learn how to use the equipment, but they also use other people's apps, which is fine, you know, if that's the experience that they like and they use our equipment. So I look at it, it's good exposure, it's good education, and it allows them to get a better experience at our clubs, which might lead to more workouts like we're seeing.
Do you guys still do the free pizza?
We don't. We haven't restarted.
The free pizza is done?
I know. We have Tootsie Rolls. We have those still, but we haven't done that since COVID. But you know, we keep talking and debating about bringing it back.
Tootsie Roll's not a pizza.
No, I'm sorry. It's true.
I'll give you a little boost. I don't know. Your mention of Richard Simmons has me hearkening back to my mom working out to his "Wake Up and Breathe."
Middle of the living room.
Very fun
leg
memories.
warmers.
Very fun memories of that period. Chris Rondeau, great to see you as always. Planet Fitness
Thanks for having me
CEO.
on.
Thank you. And we're continuing to watch former executives from SVB and Signature Bank testify before the Senate Banking Committee. We're going to bring you the latest headlines as they come. We'll be right back.
Let's do a quick check of the markets, sponsored by Flex Shares. We are mixed for the U.S. major averages right now. The Dow and the S&P 500 in the red, while the Nasdaq is clinging to some gains to the tune of about 0.2%. We'll be generous and round that up to 20 points in positive territory is what we're seeing for the tech-heavy average. S&P lower, though, by about 0.25%, and the Dow Jones Industrial Average down by about 0.6%.
And what better way to leave you than with some big interviews that are coming up on Yahoo Finance Live. ChatGPT heads to Capitol Hill, where Rochelle Akufo is going to speak with a panel of experts as OpenAI CEO Sam Altman testifies before Congress. You don't want to miss that.
And are corporate towns the future of work? Elon Musk seems to think so. Rochelle will speak with an advisor on the future of Snailbrook.
That's what it's called,
name.
Texas, yes. Plus, stay tuned for our very own Jennifer Schonberger's conversation with Senator Elizabeth Warren. That is a first on Yahoo Finance. Very curious to hear what she thinks about the bank hearings today, the debt ceiling fight, and much more. That's coming your way at 3:30 p.m. today. That is the don't miss, can't miss interview of the day. And we'll be back tomorrow. Have a great one.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this morning. The AI debate arrives at the Hill. A Senate subcommittee has the chance to grill OpenAI CEO Sam Altman. Regulation is the word of the day, but what form could it take? We'll ask our panel coming up next. And a brutal earnings report from one of the nation's biggest retailers. Home Depot warning on sales after its biggest revenue miss in over 20 years. We'll get the market reaction from the NYSE. And building a utopian town. Should your boss own your house? We laser focus on Elon Musk's reported Snailbrook project and ask if it could solve the nation's growing housing problem. But first, let's take a look at how the major indices are faring this morning. A mixed picture. The Dow just slightly in negative territory there, down about 2/3% there, but off about 200 points. The S&P 500 also down about 1/3%, down 14 points. Tech-heavy Nasdaq, they're the only ones seeing some shoots of green there, but up barely, just about 1/10% or 12 points. Let's also check in on the Treasury market here. We're seeing shorter-term yields here up about 1.6%, the 10-year up 1.5%, and the longest-term yields, the 30, up 1.5%. Stocks have a lot to digest here, especially amid those debt ceiling talks. Well, business leaders, including OpenAI CEO Sam Altman, gather to face a Senate Judiciary Committee over the growing presence of AI. And this comes as lawmakers grow weary of the potential risks tied to artificial intelligence. Here with what we expect to learn from today's hearing is Yahoo Finance's Dan Howley and Ali Garfinkel. So, Ali, let's first start with you.
So first things first here, Rochelle, there is a lot of talk about history. Now, why, right? First things first, I don't remember the last time I heard the phrase printing press so often in anything I was covering, let alone a congressional hearing. There's also a lot of talk about the Industrial Revolution, but why am I bringing up these historic parallels? Because they're trying to communicate the gravity of the concerns these senators have. Right off the bat, the Industrial Revolution parallel, for example, ties back to jobs, concerns about worker displacement. And in this first hour of the hearing, Altman did, to his credit, immediately acknowledge that, yes, AI will have an impact on jobs. But I think it's important to say these historic parallels actually belie something even deeper, which are concerns about society's safety, concerns about democracy. Senator Josh Hawley was particularly drastic in his descriptions of the depth of his concern.
We could be looking at one of the most significant technological innovations in human history. And I think my question is, what kind of an innovation is it going to be? Is it going to be like the printing press that diffused knowledge and power and learning widely across the landscape, that empowered ordinary everyday individuals, that led to greater flourishing, that led above all to greater liberty? Or is it going to be more like the atom bomb?
The bottom line right now is that in this first hour, the stakes are high, and it's not subtext, it's very actively text. It is very, very clear that they are coming into this with a sense of gravity and a sense for how much AI can really evolve society.
And it's tough because you have the ethical questions and really trying to regulate something that we just don't know the expanse of at this point. So then, Dan, what are some of the angles that you're looking at?
Yeah, I think one of the things here is the need for regulation versus the need to allow the technology to continue to expand. There's a lot of talk here about how dangerous the technology could be if it's left or if the companies are left to their own devices, if they continue to just push boundaries and don't look at potential safety issues. That includes inherent bias included in some of the data sets that are used to train these technologies, the ability for them to potentially take jobs, the ability for them to be relied upon even though they provide false information. Those are some of the risks, and something that Sam Altman himself at OpenAI is saying, look, we need regulation, we need guardrails. But at the same time, if the guardrails are too strict, the technology won't be able to kind of prosper, and we could end up falling behind in this category. And so, this is very different than the discussion we were having, last year or 2 years ago about the metaverse, where everybody was saying that that's the next big thing, that's the next big thing. AI has already been proven as a technology to push the boundaries of what companies are capable of. Provide us with new, real useful functionality for the things we do every day. Open up any app on your phone and it's using AI. So the idea that it could be kind of corralled and kind of regulated to the point where it's not able to evolve further is also a real threat, especially when it comes to the geopolitical tensions going on between the U.S. and China. They're the two superpowers that are really trying to one up each other now in this space.
This is going to be a tough fight indeed, and really tough to navigate, like trying to regulate the entire internet as it's just rapidly evolving. A big thank you there to our very own Dan Howley and Ali Garfinkel. Thank you both. Well, in today's Senate hearing, lawmakers will look to shed some light on the state of artificial intelligence and address concerns over AI risks. Here to discuss the latest, we have former FDIC Chief Innovation Officer Sultan Megji, along with Amy Webb, Future Today Institute Chief Executive Officer. A big welcome to you both. Sultan, I want to start with you because obviously this was framed as, this could go in a couple of different directions. They mentioned the printing press versus the atom bomb. At the end of the day, though, this is a tool. So how should we be viewing this in terms of how this is regulated, given that we don't know the risks still ahead?
Well, you've framed the question in a great way, because not only do we not know what it is today, we don't know where it's going over the next few decades. Artificial intelligence has been in use in our civilization for decades now. I built some visual pattern systems back in the 1990s. And so this is part of every feature of technology out there, and it's just spreading at an incredibly rapid rate. So not only do I think we have to consider that this is a very broad conversation that's not quite at a point where we know what the landscape looks like. And as someone who has been both on the, building AI companies, but also trying to regulate emerging technology for the US government, I can tell you there's a pretty big gap between the tools that the regulatory community has and what is actually being built in the market. And it's going to be up to both parties to figure out how to work together in a myriad of different ways for the next few decades.
And Amy, as we heard, there's Sam Altman saying, we welcome regulation in this space, both from the public and the private sector here. But how do you even start to lay the groundwork on something like this? We know that IBM's Christina Montgomery referenced some of the things we saw in the EU model, this risk-based, but also some specific cases for more perhaps sensitive areas.
Sure. Well, I'd like to unpack that question and sort of address it in two different ways. First of all, it's, I think, worth noting that over the past decade or so, and certainly the past 5 years, it's been in vogue for the leaders of tech companies to invite regulation. To some degree, having this conversation on the Hill is a way of Washington feeling like they've gotten to action, when in fact, no action actually results. And we've seen this time and time again, whether it's Google or Meta, or now the founders and heads of OpenAI. So that's the first thing. The second thing is that we have now forgotten, but in February 2020, OpenAI released the second generation of its tool, GPT, and it didn't release it. It issued a press release, and that press release literally said that this was too dangerous and too powerful for us to release, which created quite a bit of buzz. Now, to be fair, COVID was about to take over the world, so we were a little distracted at that point. But in the few years since, we've not created guardrails, regulatory frameworks, alignment in any way on how we want the farther future of AI and society to look. It's not like we have an AI police force. So I think that there's some amount of, if I was an outsider looking in, I would be a little concerned with our lawmakers at this point. They're incredibly late to the party, making grand proclamations about what they think the future of AI looks like. Europe has been far ahead on regulation, as it always has. And quite frankly, I don't think that traditional regulation is the right way forward. We have laws that are perpetually unable to keep up with the pace of technology. And by the way, this technology is classified as a general purpose technology, which is probably why you're hearing references to the printing press. It will fundamentally alter economic development in our country as well as other countries. So we have to classify this a little differently and also think through how we're going to work with it differently. Because if we use the heavy hammer of regulation in a traditional sense, we potentially thwart the development of business.
So, Sultan, to that point, some of these same voices that are pushing for more guardrails are the ones still pushing the boundaries at the moment. Even this week, OpenAI launched, an addition when it comes to the search engine that comes with ChatGPT. What do you think lawmakers are going to be focusing on? Are they really even actually going to be able to tackle this, given that they really don't have the skills to keep up with what's already happening with AI?
Well, that's a great way to frame it. I'd add one other piece to your question, which is there any consensus across the two houses of Congress and the White House that can actually get any laws passed? And I think we've seen, even in as much as we've been evaluating the failures across the regulatory system and the banking sector that led to this recent banking crisis, that there is no way to get new laws passed. And so for, I think, a lot of the people involved in these discussions, they're giving speeches that are core to their constituency. You know, one side will talk about open innovation and American capitalism and liberty, and the other will talk about danger and fear and, you know, issues with equity and diversity, which is, you know, they're both right. But the problem is there's not going to be a lot of law out of it. And so my view is, for what it's worth, that we're just going to see existing statutory rules applied to these new technologies, whether or not they make sense. So you'll see the banking regulators say, okay, you can't use AI to make a credit or a lending decision, but have no mechanism to prove that that's not actually happening. And so they'll find a way to declare victory without actually doing anything.
And Amy, Sultan raises a good point. Even when you look at crypto and these complaints about regulation by enforcement, do we risk the same thing happening? But obviously this time you have big tech involved. You have your Microsofts and your Googles. Have regulators already missed this boat at this point?
Right. I mean, I think what Sultan said is exactly correct. We have a situation where, again, the traditional mechanisms of regulation, which work in other sectors, don't really make sense when applied to an emerging technology that has a long horizon like AI. You know, OpenAI, a couple of months ago, I saw some new components that will shift what shopping looks like, which is certainly very interesting for consumers, but could be catastrophic for brands as some of that technology starts to change. But by the time that we sort of get to the point where there's mass adoption and regulators finally pay attention, it's a little too late. And I think there's going to be this continual process of trying to catch up. And then once everybody arrives from government, they've got the wrong tools to manage the situation. So the better way forward, because the ChatGPT function and OpenAI as an organization is one tiny piece of an enormous AI umbrella. And you know, it's been decades in modern development, but quite literally, we can trace back hundreds of years to the foundations of what we're using today. The more that we punt on this, and I really do view what's happening on the Hill right now as a punt, the worse that this gets for us the further we go into the future.
And to that point, Sultan, so what are we looking at in terms of next steps here? I mean, you had Meta releasing, you know, made available to academics its own version that they then turned into open source AI models that they then share freely. Given how fast this is going, what are the next steps here then after this hearing? If this is supposed to try and lay some of the groundwork and some of the rules that private companies may or may not have to adopt at this point?
It's going to be the wild, wild west for the foreseeable future. I mean, to the point where, you know, I was kind of hoping out of these hearings, we would at least get to some degree of defining what artificial intelligence is, because for the most part, what's out there is not actually artificial intelligence. It's dynamic programming, it's machine learning. These are, you know, computer science terms. And, you know, the internet wouldn't work without dynamic programming. The internet wouldn't work without machine learning. So getting to a point where we can define the conversation so that we can then decide what appropriate framework we might want to put in place next, that would be a win. Sadly, I don't think that's going to end up happening. And this is a multi-year journey for the U.S. Congress, and we've kind of set the table, but I'm not convinced we're going to see anything useful. I think if you're an academic, this is one of the most exciting times to be working in the space. I certainly think so. If you're on the private sector side, there's tremendous opportunity using tools that include machine learning and dynamic programming to drive significant efficiency into your business or to build new products and services that will be highly innovative. And the private sector and academia is just going to run far faster than the government will be able to keep up.
Certainly on that pace already. A big thank you to former FDIC Chief Innovation Officer Sultan Meghji, along with Amy Webb, Future Today Institute Chief Executive Officer. Great conversation with you both. All right, taking a look at shares of Sea Limited trading to the downside, off more than 14% right now. This comes after a big profit miss in the first quarter for the internet service giant. Sea reporting adjusted earnings per share of 15 cents compared to nearly 63 cents estimated. The company's digital entertainment revenue dropping more than 50% on an annual basis. And sales of goods also dropped nearly 9% since last year. One upside in the report, though, is Sea's e-commerce segment, revenue climbing up 50% year over year. Well, despite today's drop, Sea has actually been soaring this year, as you can see year to date, up more than 44%. All right, stay with us. Coming up, Ariel Property Advisors President and founder Shimon Shukuri joins Yahoo Finance to talk about the future of work and the rise of corporate towns. Stay with us. Let's do a quick check of the markets sponsored by Flex Shares, seeing that selling action picking up for the Dow there, now off more than 220 points. The S&P 500 also down about 1/3% there. The only bit of green we're seeing right now is the Nasdaq being pushed up by Google, Amazon and Nvidia right now. Well, in a post-pandemic world, office occupancy hovers just under 50%. That's according to a report out from Castle. Now, many workers still opting for hybrid or full-time work from home. But what if work was your home or extremely close to it? Enter Elon Musk. The Tesla CEO has purchased land near Tesla facilities outside Austin, Texas, where he reportedly plans to build a community for employees dubbed Snailbrook. That's according to a Wall Street Journal report. Now, Snailbrook isn't Musk's first foray into a corporate community. In 2021, Musk encouraged employees to move near SpaceX Starship facility in Texas. The concept of a company town is not new and was popular practice in the turn of the century for mining and railroad companies. But in an age where less folks are traveling to the office, could companies like Tesla incentivize workers with affordable and nearby housing? Shimon Shukuri, founder and president of Ariel Property Advisors, joins us now with a deeper dive into what this could mean for the future of work. Great to have you on the show here. So this is a curious proposition here, something, I know we've seen it in, with companies like Foxconn sort of building these communities, having people closer. How do you see this working though in this day and age?
First of all, thanks for having me. I think that we always have to look at the bigger picture of why this is happening. And one of the things that we learned about is statistically by 2035, the United States will be short 4.3 million housing units based on the National Multifamily Council. And I think that's a really important statistic to understand. We are in a housing crisis. The second statistic is from my hometown, which is New York City. The Real Estate Board of New York is telling us that we'll be missing 560,000 units in 2030. And when it comes to that, there are two elements that policymakers, public officials can help with. One is they focus on regulation, which is important for low-income housing, but they focus less, unfortunately, in many cases, on the incentives to build more housing, which is the supply side of the equation, which is super important. So you're mentioning the Elon Musk situation where he said that he left California because of overtaxation and overregulation, and that's part of what's happening. I think he's looking for solutions that are beyond what the public officials have been presenting. And I can give you some examples or some successful examples of what has happened in New York City over the past few years that was successful and what's happening now that's a little less successful.
Yeah, let's get to some of those examples because, so that way we can get to the reality of what's been working and what hasn't been working so far.
Perfect. So between 2010 and 2020, New York City added 117,000 residential rental units. That's 68% of the total construction that took place in the residential world. And most of it was because there was a 421A or Affordable New York tax abatement. So residential developers had the incentive to develop residential rentals with a component of affordability. However, that program stopped in June of 2022. And you see that the first quarter of this year has only 9,000 plus scheduled permits. And that's about half of what it was the quarter before. And I'll tell you that that's going to decline because of these misalignment in incentives. And incentives, by the way, are sometimes something that the cities can do that doesn't cost them much. The first incentive is zoning. When you provide the zoning to or allow more density, you're essentially allowing the building to be built or a bigger building to be built within the same location. The second thing is the tax incentive that I just described, the property tax incentive. If you have a vacant lot today, it doesn't produce tax revenue. If you build a building, if you incentivize the developer to build a residential rental building, it's adding housing, and it's adding jobs. And in the future, while that tax abatement phases out, you can benefit from taxes as well.
But Shimon, what about tying your fate essentially, not just now your job if you take on a job here, but also literally the roof over your head? If you get laid off and you've already tied your fate and your housing to a company, I mean, surely that's not something a lot of people are comfortable with.
Yeah, it's a great question, and it's a social question that we have to ask ourselves. And if you live in a community that provides you with housing and with your job, and you have to move away, that could be an issue. But it's not really different than living in any city, right, and being laid off and having to pay the rent in a way. So all of these items needs to be taken into consideration, and that's when regulation comes to place. In case of low-income housing or low-income needs, we definitely as a society have to take care of that. But it's the supply side of the equation is the one item that we all have to focus on moving forward to mitigate that housing crisis, and that's part of what I think that our elected official should think about. It does need political courage. I want to say one more thing about our elected officials, because I got to give credit to the mayor of New York City and to the governor. They have been discussing the supply of housing and the incentives of supply of housing here in New York City in the biggest possible way. I really hope it trickles down to the rest of the elected officials. We have great leadership. Let's make sure that we build more housing here.
So for some, perhaps, private companies who want to sort of take things into their own hands when it comes to affordability, I mean, even Mr. Beast, aka Jimmy Donaldson, known for his philanthropy, bought a neighborhood, in Greenville, North Carolina, where he grew up, for his family and for some of his employees, to be able to commute closer to work. Some backlash, a lot of people a little bit uncomfortable with that. But what do you think about the role of some of these private sort of corporate communities being involved as they do wait for more affordability from lawmakers and for prices to come down?
Yeah, I can give you examples from the commercial world, actually, here in New York City. One of the things we've seen in office that Google is building their own campus, for example, here in New York City. So private companies are doing that. JP Morgan is building their own offices here. So private companies are investing in real estate for the benefit of their employees on a commercial level. When it comes to the residential level, I think that that larger companies are sometimes taking or trying to help communities. We've seen that with Amazon. We've seen that with Google. They're not acting directly, investing in their employees' housing. They're investing in their communities. And I think that makes a lot more sense because, again, you're living in a certain community, you're working in a certain community, and as a corporation, as corporate America, you are investing in affordable housing in these specific communities, which I think makes a lot of sense, and the right social elements to it as well. If that makes sense.
That makes sense. I prefer that approach to sort of, living in, Snailbrook and wondering if I, call in sick or someone come knocking on my window, like, we have the bus coming for you to come and get you to work. A big thank you to Shimon Shakuri, founder and president of Ariel Property Advisors. Thank you so much. All right, coming up, have the days of business-friendly political parties gone away? Yahoo Finance's Rick Newman has some thoughts on the matter. Those details next. Softening consumer demand taking a toll on Home Depot's outlook for the fiscal year. Here with more on the latest market action in retail, we have Yahoo Finance contributor Remy Blair. Remy there on the floor of the New York Stock Exchange. What's going on?
Well, U.S. equity markets remain mostly lower on this morning. We are seeing the Dow Jones Industrial Average as well as the S&P lower and the Nasdaq trading on both sides of flat this morning. And of course, Home Depot shares are in the spotlight today following its latest earnings report, and shares do remain in negative territory. Earlier, the retail slashed its outlook and also said that it expects annual sales for the home improvement retailer to fall as consumers cut spending and as demand for home renovations and home improvement goods pull back. Meanwhile, taking a closer look at the details out from the earnings report, Home Depot does expect sales to decline by 2 to 5% in fiscal 2023, and that is a considerable pullback considering that earlier this year the retailer said that it expects to see flat sales. Meanwhile, first quarter revenue missed analyst forecasts as well, with revenue down by 4.2% at $37.26 billion. This is the biggest revenue miss since November 2002. At the same time, comp sales fell by 4.5% for the retailer, much more than expected. At the same time, Q1 profit did come in above estimates at $3.87 billion. And this week, we will be getting more earnings out from the retail sector. We have Target as well as TJX companies, Walmart, as well as Foot Locker at the end of this week. Keep in mind that we got U.S. retail sales for the latest month, which did show an increase of 0.4%, but that was half than the gain expected. And ahead of the report, some analysts do expect to see headwinds that are weighing on discretionary spending as U.S. consumers continue to adjust shopping habits as well as tighten household budgets.
All right, thank you for that. Obviously, Home Depot, an economic bellwether there, sending some jitters through the markets today. Big thank you there, Remy Blair. Well, the court case between Florida's Governor Ron DeSantis and Disney is still ongoing. Most recently, Florida senators approved a bill which dissolves the development agreement between Disney and the Reedy Creek Improvement District. But what impact does this have on the relationships between businesses and political parties? Here to discuss more is our very own Rick Newman. Rick, it's hard to see who's the business-friendly party here anymore.
I don't think there is a business-friendly political party in the United States anymore, and I think this goes way beyond what Florida Governor Ron DeSantis is doing in this battle with Walt Disney down there. I trace this back to the Trump administration when Trump did two things that businesses always count on the Republican Party to do. He signed a tax cut bill and he loosened regulations. But Trump also waged this trade war against China and many other countries in Europe, Canada, Mexico. So that involved new tariffs on imports, and that raised costs on thousands of U.S. businesses, and it didn't do anything for the business community. Basically, Trump was saying he was picking favorites, which a lot of critics say the Democrats do all the time. He was saying, I favor domestically located businesses. Those are the ones that benefited from the tariffs, and companies that rely on imports for components and things like that, they were the losers. And we now have a lot of data to show that the Trump trade war didn't really help U.S. businesses at all, and it hurt some businesses. So now we have Ron DeSantis going after Disney. This is purely political. This has nothing to do with any kind of business-related policy. We've got other Republicans now. They're sort of copying what DeSantis is doing. We're hearing members of Congress, especially Republicans in the House, now talking about they want to wage their own war on what they call woke capitalism. I think we're going to see a lot of this in the 2024 election. And there's a lot more to it, which I've written about recently. But it just does not look at all like Republicans are the party of business anymore in the United States.
And then you're also seeing a big push from the Biden administration, keeping a real hawk's eye when it comes to some of these mergers and acquisitions, blocking them when they can. What about that side of it? Can we expect to see perhaps less mergers and acquisitions, although we did see an exception with the bank fallout?
Yeah, for sure. I mean, the Biden administration, yes, they actually favor smaller companies rather than bigger ones. I mean, I don't think there's anything new about that on the Democratic side. But look, I mean, we've even got Republicans who want to break up big tech, not just Democrats who want to do that. In Montana, they actually passed a law recently that bans TikTok. There are some certain reasons to worry about TikTok, but I mean, like actually banning a company from operating in your state. So there's a lot of weird stuff happening, Rochelle. I'm not saying American business is necessarily going to suffer here. I think a business in the United States always lands on its feet, and it will again. But there's a lot of turmoil in terms of which political party is pro-business, which is anti-business, and it breaks down much more along political lines than it ever used to.
Interesting stuff there. We appreciate that update. Yahoo Finance's Rick Newman. Thanks so much.
See ya.
All right, coming up, this year's winners. How's your commodity exposure? We'll be delving into the gold and crypto trade with a Bloomberg intelligence strategist. Stay with us. A souring mood on Wall Street. The sentiment among fund managers deteriorated to the most bearish this year. That's according to Bank of America's latest survey. 65% of survey participants are now expecting a weaker economy. The 25-page survey detailed key findings on the state of the economy. But don't worry, we're here so you don't have to study the whole report. Yahoo Finance's Josh Schaefer has you covered with the 3 most important charts. Hey, Josh.
Hey, Rochelle. So we got the spark notes here, right? And we're going to start with negative sentiment. Let's start with recessions. Investors are still expecting a recession. 47% say they expect a recession in the next 12 months. That's actually down from 48% last month, but still you can see historically very high. And the key thing to know with this expectation is many strategists have pointed to the fact that since a recession is in some ways so baked in, it'll be interesting to see how that actually plays out for stocks. A lot of people already expecting a recession, so you could argue maybe that's already potentially priced into the market. Something that's not priced into the market, though, that people are still focused on has been the debt ceiling. And investors right now just don't seem that worried about it, Rochelle. So respondents here, we should note, this came out May 11th. This was May 5th through May 11th. It came out today, but that's when they were surveyed. And 71% said they are not worried about the debt ceiling as of now, and they are confident that ahead of that June 1 X date, there will be a resolution. Now, updates from Washington today do not indicate that, but it's been interesting to watch what's been happening in stocks. You can see when you take a look at the S&P 500, there has been essentially no worries, because historically what we're looking at here is a 2011 chart. That was when debt ceiling worries really took hold. Look at what happened to the S&P 500. So until we see something really downturn, Rochelle, it does not look like markets are pricing in a debt ceiling crisis. Should point out this peak to trough here was nearly 20% in 2011. So there is concern if this keeps going on, it may not be good news for markets. Final chart I have for you today is on tech. Investors still loving tech as much as they've loved tech since 2020. Now, what I really want to point out here, so what you're looking at is a spread between the short of US banks and the long of big tech. So you can see when the numbers are down here in big ways, that means more investors are long big tech than long banks. Now, what happened here that's interesting, Rochelle, is in 2020, you could see investors were very long tech. In 2021, the XLK popped over 30%. Let's go to 2016. Investors were very long tech. 2017, a great year for the XLK. The same thing played out in 2011. Now, when you look at the XLK already this year, tech has obviously rallied to start the year. So you sort of wonder, is the rally already baked in? Has it already happened? You can see the XLK there up already 22%. So while we do have tech investors long tech right now, I am curious to see if that might already be priced in, and this might be the end of what has been the rally in those years past. But again, 3 fun charts to sort of see where we're at right now. Interesting to see what happens with that debt ceiling crisis.
Indeed, got a lot of moving parts there. Great analysis there from our very own Josh Schaefer. Thanks so much. Well, 2023 has been a year of rebounds for some beaten down assets. Bitcoin perhaps the most notable, but with inflation, rising interest rates, and the growing fear of the US defaulting on its debt, is the tide about to turn? A great time to speak with Mike McGlone, Bloomberg Intelligence senior macro strategist. Good to have you on the show here. So we mentioned Bitcoin, one of the best performing asset classes by return year to date, along with gold. So you have your traditional safe haven and something that at one point was considered digital gold or a digital safe haven. Break those down for us, starting with Bitcoin.
Well, Rachel, I think it's important to note that virtually all risk assets have been up this year. Bitcoin is one of the riskiest, and some people call it the fastest horse in the race. It's up the most, but it looks like it ran into a wall resistance around 30,000. It looks like risks are tilted now towards the downside, particularly if the stock market starts rolling over. Yet gold's the opposite. Amongst commodities, it's the significant major commodity that's up on the year on a 12-month basis. It's up about 10%. And you look at the Bloomberg Commodity Index on a 12-month basis, it's down 24%. But I think what you're seeing happen is deflation in commodities, most particularly fossil fuels like crude oils, down 40% on a 12-month basis. It's fueling inflation for gold. Yes, we have this budget crisis. But I think the biggest risk now is, as we tilt towards recession, that gold continues to outperform most assets and including Bitcoin, unless we get that stock market to take off, and it's kind of counter to what I think the Fed's wanting.
So to that point then, what do you think is going to be the next catalyst? Does it have to be a Fed pause or a Fed pivot in order to really see a catalyst here?
So the catalyst, I think it's already kicking in, and that's copper. You probably didn't expect that answer, but copper has a very high correlation, at least for the last 5 years, with the stock market. Copper has broken down. It was up 12% in the year. You know, it's the metal considered to have a PhD in economics. It's broken now. It's down almost 2 to 3% on the year. It looks like it's heading lower. That's typically an indication for risk assets, for the economy, and for the stock market. So if the S&P follows that, which I think it will, I think gold's going to continue higher. And Bitcoin is very risky. It's, you know, cryptos are the riskiest assets. Bitcoin's just the least risky, is more likely to follow copper, I think, in this case, as we tilt towards recession. Now, as far as a pivot from the Fed, that's priced in the futures market. And what's unique about it is most economists say, oh, and even the Fed says, we're not going to be easing in this year. Yet the futures are priced for it. So I think one way for that to happen is for commodities to continue to deflate, which they are, and the stock market to roll over. That might force the Fed's hand a little bit to they've already stopped tightening, to potentially ease by the end of the year.
Another commodity to watch, we're taking a look at oil. Over the past year, down almost 40%, about 38% so far. What are we seeing there? Because we know there were issues when it first came to, you know, the tail end of what we're still seeing with the Ukraine crisis. And then obviously you have things like summer oil, summer blends and things like that. What are some of the things that you're noting in the oil market right now?
It's a bear market. One thing to remember about crude oil is it peaked in 2008. Last year, it just bounced to a lower high, and it looks like it's rolling back over to that bear market. So it had a bounce in the bear market. I see crude oil, WTI, more likely to head towards about $57 a barrel. $57 a barrel was the average price from 2019 before we kicked in this massive liquidity pump that was related to COVID and the war. And there's a good indication for that happening. Natural gas has already done that. Natural gas's average price before it pumped up to around 10 was around 2. Now it's dropped to 2, it's bounced. But natural gas is the most significant measure of heat, electricity, and fertilizer in this country. And crude oil is significant, but as the world tilts towards recession, I think the way I say it might be irrational to expect demand increase on a global basis with the U.S. heading towards recession. So I see WTI in a bear market more likely to continue heading lower, following natural gas, and in this case, kind of in sync with copper, which has been breaking down recently.
And I have to ask you about Home Depot. Obviously, when you look at some of the deflation that we saw in lumber prices, weaker consumer demand, when you look at it as sort of a bellwether of commodities, some of these other home builders, you have all these commodities sort of built into the business. What is that telling us right now?
Bear market. I'm glad you mentioned lumber, Rachel, because it's not a significant commodity, but it's a good indicator. It's dropped to the same price that it first traded in about 1990 after that massive pump last year. And it was one of the biggest rabbits in the bull market, and the rabbits have collapsed. Natural gas is a more significant rabbit that has also collapsed. I see the dominoes falling. Copper last week broke down in the year. Crude oil is breaking down. Sugar is one of the few that's up, but it's not significant. And there's only one outlier. All that deflation we're seeing from commodities is keeping gold inflating. I think that trend's going to accelerate, particularly as we tilt towards a recession.
All right, great stuff. Thank you for your insights. We do appreciate you joining us. Mike McGlone there, Bloomberg Intelligence Senior Macro Strategist. Thanks so much. All right, coming up, Tesla is revamping its Model 3. So what does this mean for China? Our own Prasa Romanian has that breakdown next. The EV race in China is heating up as Tesla's long-awaited Model 3 refresh reportedly nears final trial production in Shanghai. This according to Bloomberg. For more details on this, we have Yahoo Finance's Pras Subramanian. Looking forward to this update, Pras.
Hey, Rochelle. So yeah, this the Tesla Model 3 update, like you said, nearing trial production in China, according to Bloomberg. This version will be longer, sportier, sleeker, a sleeker interior design that is, and it's also very secretive down there because Tesla's making workers lock away their phones in special lockers so they don't take pictures or leak photos of the production line, which actually they may shut down part of the gig of Shanghai for this for a few days to get ready for it. So, you know, this rumor kind of goes back all the way to November when Reuters first reported that this Project Highland, codenamed for the Model 3 update, was going to come out in China. Because this is an important update because the Model 3 is sort of long in the tooth. It's been out since 2017. So updates sorely needed here. But I think a big part of this is also a big part of this is the fact that they want to improve the prestige of the Model 3. It's been out for a long time, as I said, give it more oomph in the market, in the competitive Chinese marketplace, and possibly raise prices too with this new model. So it's also played to boost profitability for Tesla.
And one of the things, I mean, come on now, I need a new Tesla model to come out. I need something fresh that's all the way fresh. Now they're going to be having their shareholder meeting coming up this afternoon at 4 p.m. Eastern. Is there anything that you would like to hear that you're hoping that we hear from Tesla today?
Well, definitely a few things we're going to hear about are the shareholder votes from board members like Robin Denholm and J.B. Straubel, the former co-founder who came back to Tesla. I think people are hoping that that goes through because he's sort of known as a steadying voice potentially against Musk and his fieriness. But from like things that maybe investors want to hear, maybe Tesla fans want to hear, maybe they want to hear more about that Model 3 Project Highland. Maybe they want to hear more about that Gen 3 platform. I don't think we're going to see that, but we might. You never know. Tesla, they're known to sort of surprise here and there. So I think you might hear more about these potential product updates if we're lucky. But likely they'll talk about demand, pricing, and things like that in terms of corporate governance too.
And certainly less distractions now that he's not the CEO of Twitter. Now he's named a new one. So hopefully we'll see that reflected in some of the focus there as well. Yahoo Finance's Pras Subramanian, thanks so much. All right, coming up, big news in the streaming space. What Comcast is saying about its remaining stake in Hulu. Next. Comcast will likely sell its remaining 33% stake in Hulu to Disney at the beginning of 2024. Comcast CEO Brian Roberts saying at the SVB Moffett-Nathanson investor conference today that it's more likely than not Comcast will cede the full control of Hulu to Disney. The question now is what price Comcast will ask for. The 2019 deal the streamers made would allow Disney to buy out Comcast's minority stake in 2024. And at the time, the value of Hulu was $27.5 billion. Cut that into thirds, Comcast was holding onto $9.2 billion in a $9.2 billion chunk of Hulu. Well, now Roberts is suggesting the final price could be higher than that. Disney announcing days ago in its Q2 earnings it would combine Hulu and Disney Plus into one app. We're taking a look at shares of Comcast, how they're trading right now. To the downside, Comcast down about 1%, Disney down 1.8%. Well, let's get you a final check of the markets before we go. We're still seeing a bit of a mixed picture here. Only the Nasdaq in positive territory, up just barely, though, by about 1/3%. Some of that selling action slowing down off the session lows for the Dow, down about 210 points. The S&P 500 also down about 10 points as well. We're taking a look as we're seeing markets trying to make sense of what they saw with this debt ceiling debate that's still ongoing, as well as that disappointing outlook that we saw from Home Depot, really putting some jitters here as people wonder about the economic outlook here, and especially a picture of the retail industry as well. Well, that does it for now. I'm Rochelle Akufo. I'll be back with you at 11 a.m. Eastern. I'll see you then.